pinching down and pinching pennies. I just think that sends a really bad signal to your brain that you're in crisis mode and you got to hold on to everything. And Patrick, whenever you went gambling, when you were flush with cash, you always won.
Are you thinking of sneaking past
broke,
or going all in?
Right decision.
I'm curious about your strategy.
I don't know about the first part because I lost a lot, but that second part's very true. When you're living and dying on those bets, they just never seem to go your way, oddly enough. I don't know why that is.
Yeah, so again, the math is you've got to have extra, and everyone, even if it's $10, even if it's $15, you can go down to a local coin shop and buy a $15 coin. But here's what I do know, and I know this from personal experience. If it stays in your bank account, you're gonna spend it on dumb shit. And here's the crazy thing, Patrick. You talked about how people don't want to spend that $2,000 and put that into an investment. But you know what they will do? They'll go buy a $1,000 couch or a $2,000 couch. Do you know what that couch is worth the second you buy it? The second you take it home, and that's a used couch, at most $500, at most. And probably less than that. If you own it for 3 years, it's going to be zero. That couch has no value. We have no problem spending $2,000 on stuff like that will definitely go to zero. Spend it on investments. I'm telling you, that's just the key.
That's just rich people, poor people mindset. Those are things that poor people do, and that cycle perpetuates, and they can never ever get out of it. Coincidentally, on the rich people side, the reason why the gap is getting so wide right now is because, you and I talked about this off camera, Rob. Look at some of these places to where, the rich are getting extraordinarily rich and literally everybody else is poor. Places like Venezuela. You hear nothing but their currency crashing and the dictatorship and stuff like that. Have you seen their stock market? It goes bananas. When you devalue the currency, the stock market usually does really, really well. You can just look no further than Japan for that. So, you can decide which side you want to be on. But I've made my choice, and I think everybody here has also made theirs. Just don't be afraid to step over to that side, because yes, it does involve risk, but staying on the side you're currently on with mostly cash is far more risky. So now that we've gotten that out of the way, just know that this transition, whether you're doing it for the first time or whether you're simply putting more over on the other side, should not be that scary, because everybody thinks there's a lot of disadvantages in the stock market, and there are, but they're not. One, they're not that bad. Two, they can be mitigated, leaving you with all of the advantages. So let's talk about some of those advantages now. First of all, and this will be this way probably for another 10, 15 years. Rob and I talked about this too. I think we got at least a good 10, 15 years of a long-term bull market. And if you can just wait out the recessions or put your money on the sideline or do some other things we're going to talk about in this episode, you can enjoy this bull market. And if you just plop your money into almost anything random and just keep it there, you're going to do well. But you can also utilize a lot of other advantages we're going to talk about today too, to damn near make sure that investment has a very high probability of going up over time, while your cash on the other side is just going to sit there and continue to lose.
Well, Patrick, it's actually probably been about a 500-year bull market if you go back and look at history. Now, it's probably been a longer bull market than that. The problem is financial markets, as far as where we can trace back the history to people actually buying and selling shares of stock. Real estate has been around forever. That's been in let's call it a 6,000 year, and I'm not saying that's how old the earth is, but 6,000 year bull market in real estate. Now look, there's been panics, there's been crashes, there's been periods where it hasn't been good, and I get that. And that's what scares people. But look, as long as you got in, you were fine. And just take a look at this. I mean, my kids turned in their 20s after COVID. They're looking at trying to buy a house, and it is unaffordable. It's just unaffordable. How many people have said, oh, I wish I would have been able to buy a house before COVID? Now, my kids just weren't old enough. They just weren't old enough. But there were people that were old enough that were scared to buy that house. and they are kicking themselves for it now. When it comes to investing, there is no good moment to get in. It's more important just to get in, even if it's near a top. Because the risk is that you're going to be sitting there and be priced out of the markets. So look, this bull market, there is no guarantees. So we could look back 2,000 years and be like, hey, look, it's been going up the whole time. And yes, there's dips and falls, but for the most part, anyone who's played the game, anyone who started investing in their 20s, by the time they were 70, they did very well. There's no guarantee, but as far as guarantees go in the financial markets, this is about as good of a one as you get. If you are committed to putting money into investments your entire life, anytime you earn money, yes, you can still lose, but it's going to be very, very, very difficult. So like I said, I don't even think you should be scared, because this is the closest to a guarantee that you could possibly get. And again, you're not trying to pick the best things. Buy at the high. I don't care. Look, if you started investing in 2008, the worst time ever, but you said, hey, I'm going to put X amount of dollars or X percent of my income into the stock market every month for the rest of my life. And you started in 2008 and you didn't chicken out and you just rode it out and you were buying the whole time the market was tanking in 2008. And then in 2009, it was really ugly. We had a couple of panics in there, but you just kept buying and you did that for the last 10, 15 years. You won. You won. And that's why I said earlier, in investing, you need to understand the game. You're going to win this game not because you picked a good investment. You're going to win this game because you picked an investment and you're committed to it throughout your entire life. There's so many advantages. Again, I cannot stand up here and say it's a guarantee that in 50 years the stock market is going to be higher, because I can't say that, because there is a chance. But if I ever said it at any time in human history, I was right. So I could be wrong this time, but as far as a guarantee, this is as close to a guarantee as you get.
And this flows really good into the other point I want to make, because I don't completely agree. I mean, I hate the word guarantee for one, because that speaks to people who are like super, super risk averse. And risk averse people mostly just hold cash. And that's one of the reasons why I don't know any risk averse people who are actually doing well. You know, they are that statistic on financial news of people who can no longer afford a house and have to get 3 jobs and can't have kids because they're never around, things like that. That's what risk averse people look like. That's what they do. I am not going to be one of those people. I don't love you're not wrong technically, but I don't love the fact of like knowingly buying at or near a top, because it's all going to be fine in the end anyway. I think there is a very distinct advantage, and we talked about it earlier in the show, that almost everybody has here. And that is in your technical analysis. Do this for me. Scoot all the way back to the monthly time frame and go to the S&P 500. Put any basic ass trend confirmation indicator on your chart and tell me what you see. You should be able to reasonably determine, barring something completely out of nowhere, when an economic downturn is going to happen and when it would make sense to take your chips off the table. So if you want to do what Rob said, even though I think we're in a midterm bull market now, but we're due for a recession, and that's fine. But I'm still risk on. I'm still bullish. I still hold the QQQ. And when my chart tells me not to anymore, or if I start to see smoke where there's about to be fire, I'll let it go at that point. We are skillful enough not to just have to sit there and take it when the market drops, like most people do, not just to sit there and eat these losses. It doesn't have to be that way, and that is an advantage that so many of you have, and if you simply utilize it, the fear of losing all of your investment or even a good part of your investment, much of that goes away.
Amen. I agree 100% on that. And look, I don't want anyone to be taking what I'm saying here, right? Because I hope everyone understands I'm just really trying to encourage everyone to start today if you haven't already started. And if you've already started, just keep going. And I'm just trying to show you the biggest risk is not getting in the game. But Patrick, you're right. We're smart. We've put a lot of time into trading. We've put a lot into learning about financial markets. We know a bubble when we see it. We know these things. So we can absolutely take advantage of it. But this is where it is now, it's not about like getting in a position and selling it. It's about diversification. And this is what we're talking about, diversification. So let's say that I am managing my portfolio and it's my investing portfolio, and I think there is a bubble in the stock market. Am I going to sell everything and go to cash? I could. Or could I sell some of my riskier holdings and put those into a bond fund and put some over here into safe dividend stocks? I can absolutely do that. And then if and when the market crashes, those investments go up. And then when it bottoms out, I say, hey, let me up my allocation to riskier investments. So you can see you are still trading, but it's not like the trading we do in our accounts where we take a position, put in our stops, sell it at our target, and then go back to cash. It's different than that. You're simply reallocating everything to where you think is the best opportunity at the moment with the least amount of risk. So I just hope everyone understands what I'm saying here is that you're not just going to be like the lemmings out there who are just buying every single month and just hoping and praying that it all works out. Now look, if you do that, it's worked out in the past. Pretty good for people who did that. So again, the most important part is you play the game, but we have so many things that we've put in time and a lot of work to know these things to where we can make allocation changes within our investments.
Yeah, and even if you're not as skilled at this investing game as Rob is, you don't have to be. You can do things on a very, very basic level. You can simply enter and exit the market based on what something like the monthly chart says. I love the monthly chart because also, like we do for the daily chart in trading, a lot of bad news, for example, can be absorbed by simply zooming out. Tesla, Rob, was a great example. I was looking at Tesla and I got a signal on the monthly chart to buy Tesla at the early start of last month. I didn't get in it because I'm investing in other things right now, but I was tracking it. I was looking at it and I was like, okay, it's a go. Let's see how it does. And then all that month was nothing but Tesla FUD and how people were super bearish on it. And I was like, okay, the price is going down. I still got the signal. I would still be in normally. Flash forward all the way, another, 20, 25 days. Tesla's way up. So it's just, if you zoom out enough, like I said, the daily chart is a lot more accurate than the 15-minute chart in terms of your technical tools. It just is. The monthly chart is even better than the daily chart. It's going to lose every once in a while, but it's super, super accurate. And then when you pull your money out, you can put it into cash. That would make sense, especially if you're looking at the overall market itself. But, if we're going to go through a long-term recession, maybe 1 or 2 years, possibly more, historically, Rob, there have always been things that do really well during a recession. One of them in particular I'm thinking of is energy stocks, in particularly oil. It just always seems to do really well. So you can squat in cash and be safe, or you can just rotate it into something else that's just going to keep going up too. It's not always going to happen, but you really, really, really have history on your side.
Yeah, for sure. And as you were talking, I just came to the realization of how we look at this differently. I personally don't think anyone, I shouldn't say this. Let me rephrase this. I think using asset categories versus single stocks is a way better way to invest your money. I'm talking about ETFs. I'm talking about index funds. I'm talking about things where you can put a lot of money into them. Here's the problem. When you have a small amount of money, it makes sense. But when you are trading with hundreds of thousands or millions of dollars, and you're looking at, you want to get 100% of your money invested. Now, if you're trading 2 stocks, that's way too much. That's way too much risk. That's incredible amounts of risk. However, if you are using ETFs, you can put 50% of your portfolio into the spiders, and you can put 50% of your portfolio into the HYG, high yield bond fund. Like, you can do that and not be crazy taking risk. But again, I know people do it, and I'm not saying you can't do it, but I think taking individual stocks in your investments is one of the reasons why people get scared, because on any given day, your stock can get some really bad news on it, and it can gap down 30, 40, 50%. Especially if you're trading stocks like pharmaceuticals or biotech, those can be really nasty. But if you're buying these spiders, the worst gap I've ever seen in my life down was 10%. And it recovered very quickly. That was in like 2016, January 2016. And by the end of the day, it was down 3%. You can put a lot more money into things than you can with the trading mindset. And I guess that's where you and I look at things different. I would never buy an individual stock in my investments. I just don't do it.
That's a really great point. Yeah, we're not saying go out and buy Tesla because there's a lot of variance there. Now, honestly, in a bull market, it's probably still not going to matter. Like I said, the fundamentals on Tesla have been trash for a while, but we're still in a bull market, and my chart says to go, and that is almost always going to trump bad news for particular stocks. It's not going to trump a diseased company, a rotting company from the inside, but it's magical what bull markets will do. And if you can, just by looking at the S&P 500, simply determine that we are in one, it's pretty hard to lose. And if you do what Rob said and keep it basic and keep it into those indexes, simply by doing that, you're doing so much better work for yourself and for your money than you are by sitting out for no good reason. So now that I hope people have a better idea, I hope some of you already have, I get this, but I don't know who I'm talking to. The Forex market and the trading market is a big world with a very diverse group of people. So, hopefully we've kind of explained to you that there's really no reason to be scared. And if you're going to be scared, taking no action is probably the scariest thing you can do at this point. And once you come over to this investing side, there's a ton of advantages that are already built in that are going to suit you really well. And so you can almost, I hate to say it, almost practice and make your mistakes with your real money. And even if you lose some money on those mistakes, it's not going to be that bad, really. But I think everybody should be doing this. Now, in terms of actual psychology, which that's what this episode is about. I know it hasn't seemed this way up until now, but there's a number of things you can do here to, as we said before, get an edge on everybody else. Increase your odds even further. Rob, what is one of those things? I have a couple I'm going to add too.
I want to go back to my rant at the beginning. And remember I really get heated about this one. My rant in trading versus investing. And I hope you heard or at least could feel my, I don't want to call it anger, but my intensity about this is that in trading, we take our cash, we buy a trade, we work that trade till the end, and it's a gain or a loss, and then we go back to cash, and then we look for something else and do it again. And I said, okay, that's trading. Investing, if you look at it the right way, it will fix all of the psychological problems, because I don't think you should be trading your investments. Because like for me, if let's say that I am in the queues, and let's say the queues give me a signal that it's no longer right to be in the queues, I'm not going to sell and go to cash and then sit there for 3 months. I'm going to go and put that into a bond fund, earning 5.5%, maybe 6%. Why would I put it in cash when I could put it over here in this bond fund? Or, you know what? I could even put it in the inverse of Qs. I could put that in the inverse of Qs and go short the Qs and make a little bit of money if the market goes down. But do you see, I'm never going back to cash. The thought of trading is you take your cash, you go buy something, and then when you're out of it, you go back to cash. That's what I'm really talking about, is that's not investing. Investing is moving your money around. Okay, I want international. Hey, international is a better place to be right now. I like international. All of a sudden, hey, international is not so great. I'm going to go run and hide in bond funds. For me, going to cash just doesn't really make sense. Now, yes, cash in a brokerage account is going to earn money market rates, which are better than cash in your checking account. But you can park that money in like SGOV. SGOV is it's a short-term government bond fund that pays like 5% right now. That's where you should park your cash. And then when all of a sudden, when you think there's a better investment, you're going to move it. Now, if you think about it in that way, all of the psychological things that come up with trading about, hey, am I right? Am I wrong? Am I getting the timing right? Am I getting the timing wrong? They kind of go away. They go away because everywhere you're moving it to is there's not a lot of risk. You're using ETFs, you're using index funds, you're using things that have really low costs. And yes, you might get it wrong and you might park it in the bond fund while the stock market rallies 20%. Look, that's going to happen. But guess what? You still made a return. And as long as you're putting new money in and you're reallocating it, you're going to do so well. And that's why, again, for the psychology part of this, if you understand the game you're playing, I just don't even see any of the psychological issues from trading coming into the equation because you're not trading. This is totally different. You're simply reallocating money to certain places. And yes, sometimes you're going to miss some things. Big deal. You're putting new money in all the time. It's growing all the time. And as long as you don't really screw it up, you should do pretty well in your life.
You really should, and that's kind of what the psychological part here is all about. Is kind of because the main psychology that comes into play here is fear and uncertainty, because people just don't feel like they have a really good grasp on this market. I mean, for God's sakes, when I was growing up, you had to go to a good college and study the market for 4 years, and then take an internship, eating shit at a big brokerage firm, and learn on the floor that way, and then only then were you good enough to be able to pick stocks. And it's just not that way anymore. But I still think people have that idea in their head. Like what Rob was saying. Let's say you want to rotate into oil stocks or international. How will you even know when it's time to do that? Your chart will tell you. Plain and simple. And then if you want to drill it down even further and look at ETFs or even individual stocks, that can be daunting. I get it, because this is not your expertise. This is not something you have a lot of experience in. But guess who does? The analysts who work at a lot of these free companies. When it comes to fundamental analysis, it's not the best, it's not the most comprehensive, but it is quite good. And they will do all of the work for you. And it costs you absolutely nothing. And a lot of these places that I'm about to talk about, they've shown. They say, look, take all of the stocks that our analysts liked and all the ones that they didn't like, and let's put them head to head. The ones they've liked have really outperformed and done really well. So, Rob, if you have any to add here, the ones that I see are the ones that I've seen that I've actually liked and are pretty easy to follow. Yahoo Finance has their own analysts, all free. There is a stock screener site that I know Rob really likes called FinViz, and they have their own in-house analyst, and you can sort all the stocks they like and all the ones they don't. There is a company called XAUUSD, ZACHS. They even have an app, and they actually do more than just give a rating. Sometimes they'll actually tell you why, which for free is not something you normally get. Usually you have to have the paid versions to get like a deeper analysis. And then check your broker. I'm with Charles Schwab. They have their own analyst. And that analyst will tell you if they approve in the thing that you're looking at before you buy. And if it's a buy or a hold, I typically go ahead. If it's a sell, I take a step back and I want to see if he says anything about it. Or I want to go to Yahoo or Zacks and see what they say about it. And say, okay, if enough professional analysts that do this stuff for a living are not liking what I'm about to invest in, maybe I should just mind my business and go look somewhere else. This is just another advantage, another fear that we can almost completely take out of the equation because we don't know how to do these things ourselves. Rob, are there any additional sources that you can give here that you like in terms of fundamental analysis? I know you're good enough to do this yourself, but you've also put a bunch of years in, and most people haven't. So if you were one of them, where would you go to for a really quick and easy recommendation or de-recommendation?
ETFs, index funds. Look, they've done lots of studies. You're just fine in them. You're just fine. Again, do just a little bit of basic research on ETFs. They have ETFs these are just stocks that follow certain indexes. So the SPY is a stock. It follows the S&P 500. So whatever the S&P 500 does, that's the return you get on your stock. They have thousands of these ETFs. There's biotech ETFs. There's triple leveraged ETFs. I mean, there's so many ETFs here to where you can then just kind of invest in a theme. So let's say you say, you know what, I really think AI is going to be a big thing, and I want to invest in AI. Now, going out and buying any one AI stock is very daunting because some of these stocks will go to zero. They will. I know that for a fact. Anytime there's new technology, there's going to be a whole lot of companies that go out of business. I mean, just think about social media. MySpace went out of business. The first one, it went to zero. I don't think it was ever public. But the point is, when you use these tools, all of a sudden it becomes a lot easier and it's not all that scary to buy 500 stocks at once, 1,000 stocks at once. And you can start really investing in themes that you don't even need to know charting. You don't need to know fundamental analysis. You just need to be a human being looking around saying, hey guys, has anyone noticed there's not enough housing lately? I wonder what housing is probably going to do over the next couple of years. We're all smart enough. Guess what? There's housing ETFs out there. Use these. And I'm in a totally different place right now than I was when I started this podcast, because in my mind, investing is how you should do it. And then I thought of someone who was trying to trade in their investment accounts. And I thought to myself, oh my gosh, why would someone do this? Because if you're trading, then that means you're following proper position sizing, which means that your positions are like 1% of your account. What is the other 99% of your account doing? Okay, you're doing 10 trades at once. Great. What's the other 90% of your account doing? So my guess is what someone is doing if they're trying to trade their investment account is they're probably over position sizing, and all of a sudden that's trading. And all of a sudden all that fear comes in that if you don't get it right, if you're at 50% position size and you get that wrong, it's going to kill you and you're going to get into all of those things. I didn't even think that that's how somebody could handle their investment account. That's just how far removed I am from it. Now I finally understand, this is where my rant is coming from. Trading is trading and investing is investing. Investing, these tools, these ETFs, are really the only way that you can get 100% of your account on the line. And that's what you want in investing. You want 100% of your account invested. Now look, it could be invested in an income fund that has no risk of the stock market, but it's still invested in something. It's got to be invested 100% of it, 100% of the time.
So yeah, if you can just do some really basic things here. If you don't treat it like actual trading, but you still use the inherent advantages as a trader that you have. So technical analysis, basic money management principles, solid psychology. If you keep it simple and don't go crazy, like Rob said, I'm a big fan of ETFs too. And if you use those fundamental analysis services that are free to you, and yes, a lot of them also rank ETFs. If you just combine those things, there's no reason to be worried about any of this. There's no reason to keep most of your money in cash. It took me a long time to get here because I was so proud of the cash I was making. But when I really broke it down, that was just more and more cash I was losing to the devaluation of fiat currency over time, and I got wise. And I'm really, really glad I did. And for what it's worth, if you don't listen to the 10-Minute Contrarian Investing podcast, I will be going over some of these concepts even deeper in the next couple weeks. So mark your calendars for that. But for now, thank you, all of you, for sitting through an investing episode of the Trading Psychology Podcast. Rob and I will see you next time around.
Goodbye, everybody. Keep investing, start investing, just get in the game.
This is the Trading Psychology Podcast. This is VP, creator of No Nonsense Forex and author of the book No Nonsense Forex Trading Psychology. And with me, as he is every episode, he doesn't take losses. It's Rob Reinhold.
Hey, Patrick. How's it going, everybody? I definitely take losses, but I don't take net losses. And that's what we really want to talk about in trading, is that it is a collection of 100 trades, a collection of 25 trades, whatever it is. Yeah, you're just trying to make a profit on those group, not on any individual trade.
Yeah, and you guys know how this works by now. As we get deeper into this podcast series, we start talking about things we've talked about in the past, but expanding on them. And we're going to talk about taking losses again this episode, which we have done before, but understand that taking losses is a really broad topic. It's not just one thing. And so not only do we need to explore all the different avenues here, we need to go really deep into it and maybe even explore what's going on in your brain, because that does help a lot of people. So that is what we are doing this week. And when we go deep into all the brain chemistry, nerdy stuff, you know this is a Rob episode. So Rob, this is going to be mostly you, and just let me know when you want me to jump in, and I will do so.
All right, thanks, Patrick. So everyone, lay down, put your feet up, and let's get inside of those brains. A lot of our episodes have to do with kind of like what's happening out on the market and, of course, what's happening with you inside. But I want to go back to the very start of this podcast. We had 3 episodes right at first. And basically, the first 3 were all about the concept that as a human being, you are flawed genetically as a trader. And how until you recognize that you have things, and it's not about choice, it's not about discipline, as we talked about. It's inherently, I don't want to use the word broken, but let's use the word broken. Inherently disadvantaged to when you as a human being go in and take risk in financial markets. There are things that happen because you are a human being. They don't happen because you weren't disciplined enough. They don't happen because you weren't smart enough. They happen because all human beings have some of these flaws and biases. And we've done a lot of episodes on bias, like familiarity bias and recency bias. This is another one that is innately human. And if you say to yourself, oh, I don't have this one, you're probably lying to yourself. You may not have it as strongly as others, but all of these biases that we talk about, they've been well studied. And it happens simply because you're human. Not because you're dumb, not because you're undisciplined. Happens because you're human.
Yeah, I'll agree to that. Every single person out there, no matter even if you just come from money and you get a trust fund and you're just getting money you don't even care about, it still hurts to lose. You know, back in the Texas Hold'em days when I would play a lot, you could tell there were a lot of drug dealers there, like people who just they cared about money a lot less because they knew if they lost $500, they were getting another $500 the very next day. It meant a lot less to them than it did, a poor waiter like me. So they played a lot differently. They were a lot more fast and loose with the way they played. But let me tell you, they still hated to lose. Now, it's not like losses just didn't affect them. Losses affect you in many different ways, not just monetarily. That's why I said at the top of the show, this is a much more broad topic than a lot of people let on. So yes, I will certainly co-sign on that, Rob. And I am normally this is not my avenue, but I'm really interested to see what's going on inside of us that's creating this aversion to losses, because it's never going to go away. But if we can actually grab a hold of it and be able to control it a little more, I think it can really go a long way.
It absolutely will. And if we really narrow this down into like a definition, I pulled this off of a study from Daniel Kahneman, who is one of the great behavioral psychologists. It is loss aversion is the observation that human beings experience losses asymmetrically, more severely than equivalent gains. Let me boil that down into just like a little story. If you lost $100 or if you found $100, they have measured that it affects you emotionally 2 times greater to lose $100 than to find $100. Now you think, wait, shouldn't that just be the same? It's the same thing. You found $100, you lost $100. Why wouldn't we feel the same as humans? And that's exactly what people have been studying for decades. They've been studying this phenomenon. And again, we're going to call it loss aversion, but if you go out and study this more, it is also known as status quo bias, and it's also known as the endowment effect. So you're going to hear these other 2 terms. They've all basically studied the same thing, is that when we go out and we experience a loss versus when we experience an equivalent gain, the loss affects us twice as great as any gain will. Now, think about that in your psychology. And we've talked about psychology in this whole podcast. When you go into the next trade, you're going to try to not have any baggage from previous trades. But understand, those losses that you take are going to have twice as much baggage as any wins that come into it. So this is just such a big thing in trading, and I just don't think how much people understand this, that this reality that we experience twice as great of trauma on losses is going to affect the next decisions that we make.
And that part you said about finding money as opposed to losing money makes a lot of sense too. Just for the simple fact that if I lose $100, that's $100 that I worked for. To where if I find $100 on the street, the only work I did was bending it over and picking it up. So I think that really takes effect too, because I can remember, for example, having an account. Let's say it was $2,000, and I would trade it up to 28, and then it would come back down to 2,000 over time. And it wasn't even the money that bothered me. It was the work I put in and the good work I have done trading so well to get up to 28 that I felt just got completely erased. It wasn't about the money, really. At the end of the day, it was about the work I put in.
And it was not just about the work you put in, but you had built it up to a certain point. And when you experience that drawdown, this is human nature. Whatever you experienced on the way up was twice as great on the way down. And that's when you start to get really into the psychological problems, when you let those things affect you and your psyche so much. It is devastating. And so we've gone through like some of the examples, and they've done tons and tons of studies, and I have so many studies to share with you, but probably not enough time to share them with you. But we've talked about losing $100 versus finding it. Here's one study that I absolutely love. So they set up a simple betting game where people would go and they would bet on, like, let's just say heads or tails. Now, as they stepped up to the line, the first time they did it, they said, you're going to bet $10 of my money. So let's say that I was running this and you walked up to the front of the line and I said, okay, you're going to bet $10 of my money. If you win, you get $10 and I'll get my $10 back. If you lose, I lose my $10. Okay, so they set that up and they ran to see what people did. After that, people stepped up to the line and they gave them $10 and said, this is your $10. They bet completely differently. Now just think about this. In the first study, they stepped up with 0 on the line, and they either could have walked away with $10 or walked away with nothing. Now they were given $10, and if they lose, they walk away with nothing, and if they win $10. Do you see that it's basically the same concept? Why did they bet differently?
Well, that's a big question I have. How did they bet differently?
They were more reckless. They were more reckless when it was someone else's money. When they never had that money to begin with, they were more reckless in the way that they were betting. They were much less risk averse. But once you gave them the money, all of a sudden it became their money. And now this thought of losing their money, because they didn't care about losing your money, they cared about losing their money because it's now theirs. It caused them to become much more risk adverse than they usually would have done it. But again, they had to bet or else they didn't get to keep the money. So they tried to make it to where it was similar as possible. But when they felt they owned it, all of a sudden they became more risk averse.
And God, this is reason number 215 why I'm so glad I spent as much time in Las Vegas as I did. You learn so much that a school just could never teach you. This is again speaks to the brilliance of casinos, because they will give people credits, just like you talked about, to where they are giving you free money to go gamble with. And now that you say that, it makes so much more sense, because they're almost always not only going to get that money right back, but they're going to get that momentum going for these gamblers to get excited. And now, you gave me $300 credit. I blew through it. Okay, who cares? Wasn't my money anyway. But now I'm playing. Now I'm sitting down in front of a machine. I'm not going to stop. I'm not just going to walk away. That's not what a gambler does. That's what I would do. But that's not what a real gambler does. So, yeah, this is really, really starting to make a lot of sense now.
And it's not just credits. It's also, why do you think they give you chips? Again, they are so intelligent. They've run all the studies. They've seen what it's like when you are at a craps table or a blackjack table and people are having to bet cash. They become less risky if they have to bet their own cash. But if you give them these plastic chips that don't have all the connotation of hard-earned money, to where in your brain you can be like, well, it's different than money. People are more willing to take risk when you give them $100 in chips versus $100. It is genius. It's also diabolical. But again, they understand the human psyche. They understand that this is how everybody works. By getting people to feel like it's not real money, they become more willing to take risk. When people feel like they have something to lose, they become much more risk adverse. There's so many studies, and I would love to share all of these studies with you. Go online, pull up studies on loss aversion, studies on the status quo bias, all this stuff. You will see this has been studied extensively. I'm going to let the internet take everything after that you want to learn about this, because we want to talk about how this affects you in trading. I'm going to start off with a study done by Daniel Putlers on eggs and eggs prices. And I'm going to use this to show you what happens to people in the markets. Back in I think it was the late 80s, there was a big increase in the price of eggs. And so Daniel Putler, he followed this, and he noted that when the price of eggs increased 10%, demand dropped by about 8%. Okay, so it makes sense. Eggs get more expensive, less people buy eggs. Okay, nothing special there. Okay, then pretty soon after, about a year after, prices of eggs went down 10% back to where they originally were. Patrick, do you think demand went back to where it was?
I doubt it, because people still have a little bit of PTSD over what happened before. And they're probably going to carry that over into their decision-making now, I would imagine.
You nailed it. That's exactly what happened. Demand rose about 3%. So eggs are eggs, and the prices fluctuate. But human behavior was affected because of a change in prices. Remember, we are all human. We all do this. This affects all of us. So when you go into the markets, the first price you see on any asset class, and you talk to the old guys, I love talking to old guys, I remember when, a candy bar was a nickel, and now it cost $1.50. That's insane. Now look, we all understand that $1.50 for a candy bar that's the price. That's just the price it is. And to my kids, $1.50 is just what a candy bar costs. But to an old timer who bought it for a nickel, they think this is absolutely asinine, and they are much less likely to buy a candy bar because in their mind, that's a nickel. That's only worth a nickel, and now it's all this money. We do this all the time with gasoline. You know, we always romanticize gasoline. Like, I remember, you know, back in 2008, I remember when gasoline went under $1 because I remember that. That actually happened after 2008 when the economy collapsed. Gas dropped under $1, and I remember thinking, this is crazy. And then all of a sudden it went back up to like $1.70. I'm like, oh, I'm getting ripped off. We all do this. Patrick, you have a time in your life where you've done this as well?
Well, I can speak to gasoline too. Like, I'm younger than you, but I remember in college, if you go to the outskirts of town, they had a gas station there. I don't know what kind of gas they were offering, but it was 69 cents a gallon, and that was way cheaper than anything else. You know, like going rate was probably about 80. And so we would make pilgrimages out there to this place to fill up our cars. So this was in the late 90s, and then you had 9/11 happen in 2001, and price overnight shot up to $1.70. There was lines to get gas because people were panicking. I mean, yeah, it's absolutely different. I think gas is this is a little bit off topic, but I just want everybody to know while we're here, and a lot of you already do know this, but gas is the perfect kind of blank slate I want to use. Because you have all these people who remember when gas was so cheap. It's still supposed to be cheap. It actually got easier to produce, easier to refine, cheaper to refine, yet the price has gone up so much. It's not because gas actually got more expensive. Gas got cheaper. Your currency got worse. So if you ever want to really blow an old man's mind, let him know that, because I bet you he's never heard it put that way before. But people nowadays, especially since Bitcoin came around, we are constantly reminded of this phenomenon. But to bring it back to your point, Rob, yes, absolutely. All the regret over something you absolutely can't control. Things just are what they are, but you still remember when you could have gotten it a lot cheaper.
You brought up Bitcoin, and that is a great segue into my experience with cryptocurrency. We had our trading summit in Las Vegas, and I want to say it was 2015 or 2016. I can't remember if you were at that one, Patrick. But I remember a couple of our traders were really into this Bitcoin, this cryptocurrency. And they told me about it. They're like, Rob, you got to buy some. Now, Bitcoin was at about $80, $80. It had been up to like 300, and then it crashed back down. And they were telling me, Rob, you got to buy some of this. I'm like, okay, tell me what it is. They're like, you take your real money and you turn it into fake money. Now, look, that's not what they said. But that is just literally what I heard. That's all I heard was you take your real money that you worked hard for, and then you turn it into fake money in the hopes that everyone else thinks this fake money is real money eventually. And I remember telling them, that's the dumbest thing. That's the dumbest thing in the world that I've ever heard. And I passed on it. I said, you guys are crazy. I watched it and I watched it. And pretty soon I had to recognize, hey, this is a thing. But it wasn't at $80 anymore. It was like at 300. And I'm like, I can't buy it here at 300. I'm going to watch it go back down. And we all know the story. So I am very, very proud that my first Bitcoin purchase was in the 600s. That was my very first one. Now, yes, 1,000% late, but I was able to get over this $80 that I saw and actually buy into it. Now, look, I did not buy into it much, but the fact that I bought into it, it makes it easier for my second purchases and my third purchases. You've got to get over that hump on that first purchase. And so I missed a lot of percent, but I'm very happy that I was able to finally get over that. And then in 2019, I still didn't believe it in 2018, but I thought, all right, let's put some money into this just in case. And in 2019, when I saw all my nieces and nephews were putting all their money into it, I realized, hey, this young generation believes it's real money. And pretty soon, they're going to be the ones running everything. And if they believe it's real money, it's real money. And so Bitcoin, we all know the story, has absolutely taken off. Patrick, I remember you telling a story about Bitcoin. Can you remind us of that one?
Well, it's pretty recent, yeah. So when I bought in, there wasn't a ton of regret because I was getting it kind of sold to me during the run back in 2017. Now, it still took me a while to get on board with it too. I like the idea, but I'd seen different forms of internet money in the past and they all failed. So I was like, well, what makes this so different? But I finally got orange pilled in 2020 and bought my first at 8,600. And a lot of people got in earlier than that, like you did, and a lot of people who listened to my investing podcast got in earlier than that, or a bit later, or in the $20,000, $30,000 range. We're currently today sitting at 67, I think, and a lot of people don't want to buy because they remember a time when it was a lot cheaper, and it's our little inner child just having a hissy fit saying, I don't want to buy at these prices. I want to buy at 12,000. Well, that day's probably not going to come anymore, one. Two, if you did buy early and you buy now, all of a sudden, I think our brains tell us that we were really smart to buy back then. If we add on now, then that means we're less smart. Like over the years, we've actually gotten dumber. And nobody wants to come to grips with that. But it's not true. I'm very bullish on Bitcoin still long term. So therefore, I still think it's quite cheap right now. Only reason I'm not rushing to buy more right now is because I already have a decent amount and I want to diversify out further. That's really it. So I think if people just understand that cheap is cheap, no matter what the price is, if it's something you really believe in, but we don't do that because I don't know if it's our ego or if it's what you're talking about, Rob, that's really standing in our way.
I think some of the terminology you just used absolutely highlights why our brains F this up. When we look at things as far as cheap and expensive, that's great if you're looking at eggs. That's great if you're looking at cars. When you are looking at investments, which trading is you're looking at an asset that you're going to buy or to short because you think the price is going to go higher. We can't use the words cheap or expensive until we know where the exit price is. So let me just ask you this question, Patrick. There's a stock at $20, and in 1 year you're going to sell it. Was it cheap or expensive at $20?
Did I sell it for a gain or a loss?
Well, you don't know yet.
Well, then I can't really say. I feel like I do enough due diligence to where if I'm buying something, I don't buy things when they're overbought and pricey. I like to buy everything when it's cheap, so I will say cheap.
All right. Again, these are the terminologies that really get us, because whether it was cheap or expensive is going to be determined by where it is when you sell it. So if you sold it at $40, was $20 cheap or expensive for that investment?
It was absolutely cheap.
Yeah. But what if you sold it for $10? Was it cheap or expensive?
Well, here's where my bias kicks in. And I think we all do this. And I hope this doesn't throw you off your point, but I will say that it could still be cheap. Just, unforeseen things may have happened in that time frame. And some of this could be my ego telling me that I don't want to admit I was wrong when I bought something I thought I was cheap. So I could very well be wrong. Don't throw that option out the window. That's still on the table. But as bullish as we can be on the things we like sometimes, I don't think I would answer that question in the obvious sense. I would say, hang on a minute. I could have still gotten it when it's cheap, even though it's cheaper right now.
Well, that right there is loss aversion in a real life situation. Right there. The definition is it is absolutely expensive at 20. Now look, if you don't sell it at 10, like you planned to do, remember you were going to plan to sell them after a year? You would be very happy to sell that one at 40. You would be very happy to take your double, pat yourself on the back. But that one you bought at 20 that was sitting at 10 and you said, I'm going to sell this after a year, and it's at 10, and you start making justifications, this is the loss aversion. This is the status quo effect. This is exactly what we're talking about, is that you are going to be very unlikely to take that loss. Where you were very, very happy to take your gain, you're going to be very unhappy to take this loss because it hurts twice as much. So it's going to cause you twice as much issues when it comes to following your trading plan. You said, I'm going to sell it after a year. It went down to 10. You're going to find all these justifications to hold on to it. Now look, maybe that was cheap, maybe it rebounded, and maybe it ended up going to 100 and you were great, and then That it means that $20 was cheap versus where you closed it. But on any investment or trade, whether something was cheap or expensive is only determined from when you close the position. Now, do you see how that, and again, I'm not just talking to you, Patrick, but everyone here, reframing the terms cheap and expensive will completely liberate you from some of these loss aversion biases.
Yeah, and I feel like I do a pretty good job of this. And I didn't always. But now if I buy an asset, Forex pairs are different because you can go past zero. That's a totally different asset class, right? But if I buy an actual asset of something I believe in, then I'm typically likely to take a lot of drawdown and probably never sell it because of the chance that it could go back up, because that's often what assets do, especially if they have value. And if it didn't have value, I wouldn't buy it in the first place. On top of that, I like to put myself in the asymmetrical investing pool. And I know through experience, because I'm no stranger to this pool, that things go up and down a lot. But when they go up, they can shoot up like crazy. You just never know when that's going to be. And you're going to have to eat a lot of shit along the way. So I'm just kind of built for this, and I'm ready for it. So if things drop, really the only time I would ever sell is if there was something terminal, or if I just needed something to sell for tax loss harvesting. That's really the only reasons I do it. I'm pretty much conditioned to let things go if it's something that I put my money and my thoughts into.
This goes back to our investing podcast, which I really loved. I loved that investing podcast that we did together, where I really came out, and you could tell how fired up I was. What's a trade and what's an investment? And I said, basically, an investment, you don't ever sell it. You just dollar cost average it and hold it forever. And you buy asset classes. I 100% agree with you. 100% agree that that's how you handle investments. When it comes to trading, you've got to treat it differently. And that was the point I tried to make so strongly, is that trading is completely different than investing. They're two totally different worlds. In the world of trading, if you sold it for less than you bought it for, it was too expensive. Period. End of sentence. No justification. No, but it has a PE ratio. Who cares? That's the world of trading. And so that's what I'm trying to do. Is I'm trying to get people in the world of trading to completely change the topics of cheap or expensive. And that's why I really like you use terms like overbought and oversold. Overbought and oversold are not necessarily cheap or expensive. They are overbought and oversold. That is a totally different definition than cheap and expensive. I do not like any of my traders to use the terms cheap or expensive when they are telling me about their trades. The other thing I do all the time is when a trader tells me, hey, Rob, I would like to know what your opinion is on this position. And then I say, great. I'll give you my opinion. And they're like, well, I got in, and I always cut them off. Say, look, I don't care where you got in. Do not tell me where you got in. That's meaningless. And frankly, I don't want to know where you got in, because I don't want to have that information in my brain for when I look at this chart and tell you my opinion of what's going on. Because we anchor into these cheap and expensive things. And if I know that a trader's in this at 24 and it's at 26, I might think, you know what? Maybe they should sell it because I don't think it's going to go any higher. Maybe I'm lying to myself because that cost basis is coming into me. So this is really, this loss aversion, it pops up so many times in trading, and you really have to be aware of it.
There's two things I want to say to this. One, I'm glad you brought that up, because the difference between trading and investing, because when I started talking more about investing, when the trading material ended, I would say things and commenters would come and say, now, wait a minute, VP, you told us back in a trading video that it's like this. And what you're saying contradicts that. I'm like, it does. But trading is not investing. And that goes back to what you're saying about cheap and expensive. Those are investing terms. Those are not trading terms. In the actual trading world, nothing is cheap and nothing is expensive. So stop looking at it that way if you currently do. Those two words, in my opinion, and you can agree or disagree with me here, Rob, have no bearing, have no use in the world of trading. And if you use them, then you're really taking everything in the wrong direction, in my opinion.
Amen. I could not agree more with what you said. They have no right to be in trading discussions. You can use terms like overbought, oversold. You can use terms like support and resistance. But you should never use the terms cheap and expensive. It's only going to cause you this loss aversion bias.
I'm sorry, Rob, if you're a no-nonsense Forex trader, we don't even like those words, but I know what you're saying. Carry on, please.
Yeah, just when you say something's cheap, understand every word you say has an effect. And I told my kids as they were growing up, like, look, whatever you do, be deliberate. Be very deliberate on what you say, on the things you think. And when you think, oh, this is cheap, when you say that word cheap, it causes your brain to think in a different manner than you want in the world of trading. You know, when something's cheap, it can't get all that much cheaper because it's already cheap. It causes all these issues that you really just want to get rid of. And probably the biggest issue I see with loss aversion is it leads to a negativity bias. It leads to a negativity bias in two ways. Number one, since taking losses is more hurtful than taking gains, most people are very scared of market crashes. Now look, as a trader, you should have no bias to long or short. You should have no bias. And hopefully you're working on that. You should go long when the market's going up. You should go short when the market's going down. Who cares? It doesn't matter. But look, let's be honest. Most people have a long bias, especially in the stock market. I don't see it in the Forex market as much, but in the stock market, there's a very strong long bias. So if let's say 80 to 90% of your trades are long in nature, potential market crashes are very scary. Very, very, very scary to you. And they're going to cause you, when something gets, quote, expensive, it's going to cause you to react.
Yeah, I'm jumping in a lot more than I thought here, Rob. Sorry about this, but I just keep coming up with really good examples that are relative to me, and so I feel like they could relate to a lot of you out there too, possibly. But you talk about being deliberate, and that's what you have to be during trading or when you're trading. But a lot of us aren't that way. Now, a lot of people have come to know me as a very blunt, direct, deliberate person, and I am. But that's not always how my brain works. You know, I'm thoughtful on certain things. You know, if I see something on the news that's politically charged, I don't just react to it and get all emotional. I try to think of, you know, why is this being presented to me? What also could have happened? What are the second and third order effects of this? You know, maybe somebody did this to get to a certain, I always try to think about stuff like that. And this is exactly why I was really good at mathematics, but I was terrible at algebra. Because math just is what it is. Just like trading is what it is. 2 plus 2 is always 4. I don't care what the new math tells you. 2 plus 2 is 4. And I can get my head around that. With algebraic formulas, I would always think like, okay, well, they're telling me to do this, but there's always these exceptions here, and maybe this could be this, and blah, 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 blah. And I took algebra 3 times and failed every time. And they just kind of gave up after a while. And that's, if you bring that attitude to trading, that, I'm going to enter this, but, there could be this, or, it's still cheap and this kind of stuff. You're taking your brain in 1,000 different directions, and none of them are going to get you anywhere, ever. You have to completely enter that headspace to where things just are what they are. There is no cheap. There is no expensive. It's just the market. Like you always say, Rob, the market is the market. Trade the market in front of you. That's all that it has to be. So if you struggle with what I just explained in real life, and you try bringing that into the trading arena, the game is over before it even starts. People who think that way cannot possibly follow a binary system like you need to follow here.
Absolutely true. I mean, it's not even possible when they go into the world of trading because they haven't done the work that we've talked about in this psychology podcast to even fix the biases that are inherent to us as human beings. I want to get back to this negativity bias because this is the one that I actually really wanted to focus on this one the most, is that if you are a long-only trader or heavily long, then potential crashes will scare you all the time. And I can't tell you how many times I see traders, And I really try to beat on my traders. We do lots of videos. We do lots of sessions together with our traders. And whenever I see a market like we're having right now, where it just goes up every single day, people all of a sudden, they start to step away from the market. And they're like, hey, the risk of a pullback is too great here. It's gone up too much. It's done all this stuff. And I look at it as, oh my gosh, it is so good right now. You should be tripling up. You should be quadrupling up. Because right now, we're reaching all-time highs. This is the best it's ever been. Why would you not want to be fully invested when it's the best it's ever been? Patrick, do you see the difference in the attitude there of fear and maybe greed on my part, but not just greed, but seeing an opportunity for what it is? Why do people feel fear when markets hit all-time highs? Now, I can answer that because I used to be a perma bear. Every all-time high that was hit, it was a joke. It was terrible. It was just setting up all the idiots for the fall. Patrick, you ever known anyone that's thought like that?
Oh, yeah. And I have a couple thoughts on this, especially as it relates to trading. This is, again, why I don't really like overbought or oversold, because I don't think the Forex market is ever overbought or oversold. I mean, it is it can get to a certain point to where it's so bad to where the government will step in and say, okay, we need to do something about it. But until that point, currency pairs can just keep going and going in one direction. So when people have it in their mind that it's like a rubber band and it's stretched out, and this whole reversion to the mean and stuff like that, I'm just not, I don't buy into any of that. That can be a real problem. So that alone, maybe it's a real thing, maybe it's not, but I don't think it is, and I don't want people thinking that, because that prevented me in the early days from being a trend trader. Because I'm like, okay, I'm just going to wait till things are overbought and oversold and then catch that reverse. That's exciting. But that's a really terrible way to trade, in my opinion, for all those reasons. Bringing it back to what you said earlier, it made me think of, why people like to just go long or even just go short. Because this is a real thing. I've gotten correspondence from this, from traders a lot. A lot of people will only want to go long, for example, because that's what they've seen, like with the stock market. Going up is what you want to do. Or going long also denotes positivity. Things are well. And when things are doing well, things go up. And you want to be a part of that. To where going down, I guess people are less likely to want to take that step for some reason. They just can't get it past their brain. But conversely, I've had a lot of people email me and mention in the comments section of some of my videos, they say, why is it that I only want to go short? And going short is the only thing that really feels right to me. And I'm like, let me guess. Is it because of gravity? And they're like, oh, that's it. I never thought of it that way. I'm like, you know how I know? Because I used to think that too. Or I used to feel that too. I knew it was wrong. But I still liked going short a lot more than going long, because gravity naturally pulls things downward. So yeah, I'm not sure how relevant these are. I think there are some relevancies here, and you can pick those out. But yeah, there are, I'm not going to call them valid reasons, but there are plenty of reasons of why people might feel all of those things. And I have either seen them all or experienced them all myself too. So yeah, they're real.
Well, Patrick, after the dot-com crash in 2001, I bet if you looked at my trades in 2002 and 2003, they were 85% short. I had a very, very heavy short bias. And as you said, I always justified it as everything has to go right for a stock to go up. But if one little thing goes wrong, the stock goes down. So any little thing that would happen, it would send it down. And it was a real problem for me, because I didn't even understand yet of this loss aversion we're talking about, is that when the markets did drop, I felt twice as bad when I was long than I made when I was short. So of course, if I go short, the market drops, I feel good and it goes again. Or if I'm long and it drops, I'm going to be on the side where I feel good about it and I don't feel twice as bad. So it's all tied up in all of these biases we have. And I really want to get into the session where we talk about how to overcome this loss aversion bias. I really like what we did and said in the investing podcast, where we basically said, your biggest risk is to not be in. Now look, We can't take that automatically into traders because that leads to overtrading and a bunch of other problems. But your fear should still be the fear of missing out. And look, we did a whole episode on FOMO. Go back to that one. There's the wrong way to do FOMO. But when the market hits an all-time high, you should be thinking, oh my gosh, what if this keeps going another 4, 5, 6%? How can I make trades that will be safe in that environment? Not, oh my gosh, it's gone up too much. It's not going to go up anymore. I'm not going to be a sucker holding the bag. You are going to miss way more opportunities than the few times you bought at a high and it reversed and took you out of a trade. And guess what? If you're trading correctly, it's just you had your stop in, you had your order in, and it took you out just like any other trade you made over the last 3 years took you out. But you see how that fear of that loss will keep you out of trades. We need to reframe this to, hey, you know what? Losses suck. I know I'm going to take them, but I need to make as much money on my winners as I possibly can. That's where your focus is. Not in, oh my gosh, this one's gone against me. I don't want to take the loss. Screw that one. Take that loss. Who cares? Get into something that's great. That's how your attitude needs to be. And it took me years to overcome being a perma bull, and it took me lots of introspection and thought about it. So if you find yourself as a perma bear, if you're a perma bear and you're scared that the market's going to pull back all the time, so you're too scared to get into it, you've got to work on that. That's simply loss aversion. You simply need to reframe it to where your greatest risk is missing out.
And I just want to highlight and remind everybody, too, that when Rob talks, Rob is speaking from his arena. And at Maverick Trading, you can not only trade Forex, you can also trade stocks, you can also trade currencies. So my hardcore strict Forex traders understand that there are differences here. Now, as we kind of transition into the solutions part of this episode, I will just say, and I'm sure, Rob, you're probably going to continue on this too, that a technical analysis system is a good way to take a lot of this away. It's still going to be there, and that's why we make episodes like this. But if you're wondering if something is overbought, oversold, you have a nice bias to the upside, whatever, your system is going to tell you when to enter regardless of any of these things. Sometimes it's not even going to make sense, but it doesn't matter because, like Rob said, the right type of FOMO, fear of missing out, is to make sure you don't miss out on the trades that are given to you by your system. Full stop.
Patrick, the thing I love the most about your channel, and it's something that people don't even recognize, because I go in and I read the comments. I love all the comments on your videos that talked about how they struggled before they found your channel, and now they're doing great. Now they're thriving. Now they're passing challenges. Now they're joining prop firms. Now they're trading their own capital and doing great. And the funny thing is, I think most of them feel like it's because they follow the technicals. Yes, all that stuff matters, but what it's really about and what you have been able to really get into people's heads is that you need to build a system, you need to backtest a system, and you need to trade that system, and I love your saying, and get the hell out of the way. When you stress that to people, they are taking that advice and basically overcoming all of these podcast episodes we're doing. We're doing all the podcast episodes on how you can screw this up. If they do what you told them to do, and the people that do it, they end up leapfrogging, having to learn all of these biases that we all have and how to fight our biases. Yeah, they're still there a little bit, but you have done 95% of the work. It's absolutely imperative to trade in a systematic manner and get the hell out of the way.
Well, I appreciate that, Rob. And I like to think that it's more the money management and psychology side of things, which a really good trading algorithm should kind of encapsulate in itself. And I'll even get people that say something kind of passive aggressively to where they're like, yeah, I don't really like VP's technical analysis at all. I think he's a doofus. I hate indicators. But I got to say, The money management and psychology stuff are, or if you listen to anything, listen to that. So I'm like, okay, well, thank you for the half positive comment. But yeah, that's really what it is. That's what makes podcasts like this so important, because nobody really covers it. And if they do a terrible job of going in depth. And as we've seen, and as people who listen to this podcast understand, you need to go in depth on these things, because no matter how much we want to follow our system the way I tell you to, it's much harder than it looks. So Rob, not only just following a trading system, you have some other possible ways to fix this loss aversion problem that people have. And I'm curious to hear you. I can see them on the outline. I'm curious to hear you expound on them a bit.
Well, two are actually right along the lines of systematic trading. I had systematic trading, and then I have trailing stops. So trailing stops, if you don't know what they are, please jump online and learn from someone else. A trailing stop is just a stop where you have a maximum loss you're willing to take, but you don't have a maximum gain that you're willing to take. You are letting this trailing stop dictate where you're going to get out of the position. We use this in the Flat Earth Trading Society on 100 random trades, and it ended up producing a 15% profit over 100 trades. So it can work. So again, but it's all about systematic trading. The reason it worked is because we did it the exact same way 100 times in a row. And Patrick, I want to go back to what I said earlier. The greatest thing about your channel is that you and I both know trading is really hard. It's really hard, not because of it's hard to learn technical analysis. That's easy. It's really hard because the market is really good at getting you to break your rules and really good at deviating from your system. And in our podcast, basically all of our episodes have been about things that make you deviate from your system. And you have been able to get people to buy into their system, test it to where they're really confident in it, and let them run it. So that is how you overcome loss aversion, is you believe it, you believe in it, you go in, you trade it. If there's any issues, you fix them, but let it run. And then like the Flat Earth Trading Society, you just let it run and you see, holy crap, this actually works. And it reinforces even more to not deviate from your system. So that's really the way to overcome this loss aversion, is to create a system, backtest it, trust in it, trade it, make adjustments if you need to, and then just keep going. That's really the whole key to it.
And it's the whole reason why I created the system I created. Because, look, price action's fine. There's a lot of people who did really well with price action and still do. But for me, the way I just told you my brain worked, when there's all these other exceptions that could come up, I needed something a lot more definitive. You know, I would be looking at price action, I would say, okay, well, we're breaking this support line to the upside. But this other thing is telling me to go short on this other time frame. You know, which one am I supposed to follow? Even if you tell me it's this one, I still have this other thing over here telling me to go the other way. And so I don't have confidence in what I'm trading in. And that's going to be a problem, especially if I take a loss, because now I'm going to second guess why I did it in the first place. So, you know, love indicators or hate them, at least they give you something definitive. And that can really go a long way, because it takes a lot of these other things, including what we're talking about today, out of the equation altogether.
And that's the key, is that we have all these biases as human beings. Yes, we can work on them. Yes, we can try to get better at them. But why not just create a system that jumps them all, that fixes them all? And that's just what I love about your channel, and I really hope that people have been taking from you, is that if you follow systematic trading, you are going to fix a lot of your issues. And if you ever break your rules of systematic trading, it's all psychology. It's nothing about your system. It's all about you. You just got to fix that.
Yeah. And so even though the systematic trading system can help eliminate this, it doesn't mean it's not still there. And it doesn't still mess with us. So that's why we do episodes like this, to not only identify the problem, because you can't fix something you can't identify, but to talk about what's really going on inside of our brains and why we probably feel this way. And if we can at least do that, then we can come up with a solution to try and get rid of it as best we can, even though the overall solution has been obvious to us since day one. it doesn't mean these things still don't exist. So I hope Rob and I were able to shed a lot more light on this and help you move on and get rid of a lot of these things that are weighing you down. And Rob, on that note, do you have anything else to add here?
Nope, that's it.
All right, well, we've gone over 50 minutes, so that's a good thing. Thank you, everybody, for joining us here on the Trading Psychology Podcast. Rob and I will both see you in the next episode.
Goodbye, everybody.
This is the Trading Psychology Podcast. This is VP, creator of No Nonsense Forex and author of the book No Nonsense Forex Trading Psychology. And with me, as he is every episode, it's the man who should be president of the United States. It's Rob Reinhold.
Thank you, Patrick. And look, I don't know about should be president, but anyone who wants to be president, that sounds like the worst job of all time. Like, I have no desire to be the president of a country. It sounds terrible.
Truth be told, I don't think they do either. But welcome, everybody, to the election edition of the Trading Psychology Podcast. Now, you're going to be covered from all angles here because I did, as far as pure Forex trading goes and what you should be doing during election season or should be looking to do, I've already made a video on this. You can simply go to my YouTube channel and search for it. And I listened to that video over the weekend, and it still holds up quite well. And now you also, for fans of the channel, probably remember last Saturday, a couple days ago, we had our 10-minute contrarian election episode. So that's more what to do from an investing standpoint. And today, we're going to go over what to do from a trading psychology standpoint. So we have you covered on every single angle here. Now, this is an episode that Rob put together, and we've gone over it, and I'm excited to get into it, Rob. So one thing I want to do before you get there is, if anybody doesn't want to go watch the election episode I did on my channel, not the investing one, the trading one, the one thing I will say, if you just want the most important piece of that video, was to just simply not trade during the day before, the day of, and the day after the election. Because as we always say, if you give the big banks a reason, if you give them a green light to come in and mess with your trade, they will do that. So I would expect some pretty crazy volatility that day. And I would expect a lot of things to not go traders' way. So just for a few days, get out of the pool, enjoy your time off, watch the election, or don't, and come back towards the end of the week and see what the overall climate is in the market. You know, we might have a situation where this thing goes on a little further than we wanted it to. And that might also create chaos in the market as well. But I think probably the Thursday or Friday of this week is a good time to check back in after you've already shut everything down and see where the market is. Rob, do you have any thoughts on that before we get into the actual meat of the episode here?
I think that is very prudent advice. I've been through many elections in my 27 years, and I'm trying to think back, like I really just cannot remember the first couple. But I definitely remember the last couple. And one thing that you pretty much are always going to see is especially Tuesday night. Tuesday night, as they're starting to call states for one party or the other, you really start to see the volatility. And that volatility really grows overnight on Tuesday night and into Wednesday morning. This is all U.S. time. And then probably by Wednesday, maybe after the markets close, and maybe even into Wednesday night, everything starts to mellow out a little bit. Now look, there are some elections where there was no clear winner. I remember we were just talking, Patrick, about the hanging chads. Was that the 2000 or the 2004 election? Do you remember?
It was Bush and Gore. I don't recall exactly which one it was. I want to say, because Obama was 08, so maybe 04, yeah.
Okay. Regardless, we didn't know Florida. Florida was ended up being won by like 530 votes in the whole state of Florida. That's just amazing. So look, all of that is just going to create volatility. And volatility is good if you're a short-term trader. And if you are, into trading ranges and things like that, that's great. But for anyone who's a trend trader, I think the advice is great to just sit it out. Sit it out and wait for the markets to come back to a more reasonable kind of movement.
Yeah. So I think we're all in cahoots on that, as I think you all should be. I think a lot of you who've been here, more than 4 years, understand this as well. It's just not a time to be in the market. The only people who really would were people just being overly opportune, and those people typically don't last very long. So decide what side of the fence you want to be on. And now, Rob, I'm sure a lot of our listeners probably think that their political bias does not get in the way of their trading, or cannot get in the way of their trading. They trade the market in front of them. Very simple. It's what we always say. But you have some evidence to the contrary here, and I would like to hear about it.
Well, thanks, Patrick. I'm going to give you evidence from outside sources. This has been studied. This has actually been studied very deeply in the psychological community, with lots of studies on how people have these biases, these perspectives. I have seen it firsthand at Maverick Trading and Maverick Currencies, where I have had to like reach out to traders and be like, hey, what are you doing? Like, you're only going short. Like, why are you only going short? And they would tell me, well, I don't like the way the country's going, and I don't like the election results. And it's like, no, look, you have to be able to compartmentalize these things, or else it's really going to cause some havoc in your trading. Like I said, I've seen them hardly take any longs, and the longs they took, they had no patience on them, but yet they were taking shorts in a rising market with all the patience in the world, and that was very different from how they traded before. So I really want to start off with a sports analogy, because I feel like this is a really good segue into thinking about how our political bias will affect us as well, because it's pretty much the same dynamic as a sports fan. Now, many of you don't know this, but the word fan is short for something else. Patrick, do you know what it is?
Fanatic.
Yep, fanatic. So a sports fanatic. So when we talk about the word fanatic, it just means that someone who is all in, someone who is very engaged with it. So the more engaged you are with the sports team, the more you're going to care about the results and care about the outcome. And a lot of things really break down as far as logic goes. My mom, for her whole life, I can't remember her ever watching sports, for our whole life. And then when she turned about 75 years old, out of nowhere, she is now the biggest Yankees fan of all time. She goes to spring trainings. She never misses a game. There's like 162 games a year, and she watches all of them. She is an absolute fanatic now. And I was like, Mom, where did this come from? Like, you never cared about sports, and she doesn't know. She just fell into it. But here's the interesting thing. My mom is the sweetest, most loving, wonderful lady until you start to talk about the Houston Astros. She gets this snarl on her face. Her countenance is all, angry and dark. And she hates the Houston Astros. And it's so strange because I've never seen my mom do that before. Patrick, is there a sports team that you just hate?
Less and less so now. So I grew up in a city that was very sports-centric, and so we would hate our rivals. And then once I moved away and into a place like Las Vegas, I became very Las Vegas. I only cared about the teams I was betting on, and I would bet on teams that I've grew up hating, if it was appropriate to do so. So I'm not sure what that says about me and my overall fandom. It was probably pretty suspect to begin with. But no, there are no teams out there that I hate. I understand that, it's even if you don't like the organization, it's just a group of guys out there trying to do the best they can and win a game for their city and for themselves. It doesn't matter, where they play.
How logical and how boring.
You've met me, right?
Yeah, of course. What about your favorite teams? So there's not any team out there that you hate, but what about, do you have a favorite team?
Well, of course, I do. And I don't dox where I grew up or anything like that. But for sure, and it's the teams, I always liked growing up. And then became kind of a low-key fan of the UNLV Running Rebels when I went, their football team when I went to Vegas. And they were terrible the entire time. So it was great. It was like being a Cleveland Browns fan. Like you have no expectations going in. You just you can never get let down if you have no expectations. So now that they're actually good for the first time ever, I'm not sure what to do. But yes, I have the teams I grew up with and had great memories of, with my father at the games. And then as far as college football goes, I have to pick a team, and so that was always my team.
That is very interesting because I played football, I played rugby, I played sports growing up. I was huge into sports, but I never loved a team. I just never loved a team, and I ended up choosing the Buffalo Bills, which, like the UNLV Rebels, were terrible. And now that they're actually pretty good, I don't know how I feel about it because what happens is when you identify with this team and all of a sudden this team, you start to get more and more into it, you start to lose a little bit of reality. You start to lose a little bit of just logic and reason looking at them. And you start to look at games that they lost and you say, oh my gosh, bad refs. The refs blew that game for them. And, the other team was cheating. And all of a sudden, you're no longer unbiased. You have now look at it as, and I loved it when people say, we won this game with good defense. Now, these people that said that, they were never on the field. They didn't do anything. They don't know any of the players, but we did it. We played well. And when you start to identify with this sports team, again, you just have logic holes and you have things that are going to get by you because you really like the team.
I think that was a great tie-in, identifying with a particular team. And I think I know where you're going with this, because don't we also identify with political ideology now? And social media has done nothing but exacerbate this 50 times over. Because now it's not just your group of friends that identify you with the team you like or with the ideology you like. Now it's everybody. And so now this has become a really big part of you. So two things really, and none of them are good, I don't think. One, now you're never going to be able to think objectively anymore, because God forbid everybody should know you as one thing, and now you're starting to switch teams. That's going to be a PR nightmare you're just not ready for. Two, it just really hardens your ideologies. And it probably does it too early in your life. Like I can understand if you're 70 years old and you've lived life, and and you want to vote for certain things because they affect you and screw everybody else. You've done your time. You deserve it. I get that. All right. But before that, you should be a little more objective and try to understand what's going on and try to understand what would affect the greatest amount of people. Because in my mind, a rising tide lifts all boats. But you can't do that if you're tying your identity to something or some person or some group. It's really, really hard to do. Not only do you have no control over anything they do, and you're tying your identity to that. I can imagine what a helpless feeling that would be, right? But yeah, this is really a slippery slope to go down, and I feel like most people have already gone down it and are now stuck at the bottom. That was just my rant, Rob. You take this wherever you want. I just wanted to put that out there.
I 100% agree with everything you said. And when you take a look at, again, you at first said that, the internet, social media has really created this team environment. And I'm 50 years old, so I've gone through, a fair amount of elections. And the way the division is right now, it's really, really strong. And it's funny because you actually start to see a lot of the same behaviors that fandom does. Flags, signs, bumper stickers. Like 20 years ago, that just didn't exist. It just didn't exist. So it's gotten stronger. It's gotten more. And so we just have to be understanding of it in ourselves. As long as we can see it in ourselves and admit to it, oh, I'm biased on this. Then remember, this goes back to episode 1 of the Trading Psychology podcast. Identifying your weaknesses. And then figuring out how are you going to trade successfully in spite of those weaknesses. This is one of those weaknesses. So how strongly you identify with a political party will make it a bigger issue for you in your trading. It's one of the reasons I've always wanted to stay independent. I've always just wanted to be in the middle and independent. And look, I know that's a chicken shit way to live life sometimes, but I understand that once I get too far one way, I've made some choices that I can never back away from. And I want to have choices. I saw this in 2016 to 2017. When Donald Trump won the White House in 2016, I had traders that went from being really good traders to being really bad traders. What I meant by that was that they were scared, they were pessimistic, they were doing way too much shorting. And when I talked to them, they're like, hey, I don't like the way the economy is going. And I'm like, what are you talking about the way the economy is going? Look at the economy. The numbers are great, but they didn't feel great. And then in 2021, I had to have the exact same conversations, but just with the other team. And there's actually a great economic study that was done I think in the spring of 2021. They went out and they interviewed Republicans and Democrats. And they said, okay, what is your opinion on the economy? And it was something like 70% of Republicans had a favorable view of the economy. And when they asked Democrats had about a 30% favorable view of the economy. So just think about this. This was a good economy. Yes, we had COVID, but the economy really bounced back after that. Inflation came with it, but when you take a look at the numbers, the economy was really good in November of 2020. 2 months later, they surveyed the same group of people after the election was over and after Joe Biden became president. It was the exact opposite. 70% of Democrats felt like the economy was great, and only 25-30% of Republicans thought that the economy was great. If you look at economic numbers throughout those 2 months, nothing changed. Not one objective measure of the economy strengthened or weakened from its trend. But people's perceptions wildly changed. And there's really only one thing that changed, was the political party in charge. Does that surprise you at all, Patrick?
It really doesn't, and I don't even like that question. I'm going to be like the nerdy actually guy here. You know, the economy and the markets are two different things, but I don't think most people realize that. So it would be fair to say one thing or the other. And and I think a lot of people just tie it to how they're doing. You know, there's plenty of people who eat shit in a good economy, and there's plenty of people who prosper in a bad economy. So it's a personal question too, but I know what you're saying. Yeah, the biases really do play a part in that survey. Now, I guess the way to really tie this into Forex trading, this is the Forex Trading Psychology podcast. That's the Trading Psychology podcast, but most of you are Forex traders, so let's try to correlate this here. But taking the numbers to that survey and the evidence Rob just gave with his own traders, what issues do you see popping up in their actual trading because of these biases? Is it similar to what you talked about before with that guy who kept going short, or is it deeper than that? You know, what are some of the second and third order effects from this bias that you've been able to see, with this subsect of traders that have a really hard time adjusting?
That's a great question, and I definitely have a couple things that I saw personally. Number one was the long-short ratio. The long-short ratio was probably the clearest thing I saw. I saw people that were pessimistic in 2016 all of a sudden get really optimistic in 2017. And I saw people that were optimistic in 2016 get pessimistic. And what I mean by that is that they were mostly making bearish trades, or stuff like gold. Gold's a great barometer for how people are feeling about the currency and stuff like that. A lot of people who would never traded gold before all of a sudden started trading gold because of just that perception that, okay, things aren't going the way I want them to go, and I think they're going to get worse. So I start to make different trades because of my personal feelings about the economy and about where the country is going. Now, all of that is subjective. The whole point is to use objective measures in your trading and in your investing, but most in your trading. We want to be 100% objective. The numbers are the numbers. And so the charts are the charts, the trends are the trends, and that's really how you have to look at it. The other one was I saw people be getting more reckless if your political party was the one who won. Because again, they were feeling exuberant. They're like, hey, the big party's on, I'm going to go. And some people became very risk averse. Very risk averse where, I'm going to trade half the size I used to because I don't like how things are going here. So it really was funny because it was the people that their party won started trading more, they started trading larger, and they started becoming a little bit reckless. The party who lost, they started trading more short, they started trading less size, and they started to exhibit signs of under trading to where they found ways not to trade. That's what's going to happen. And here's the crazy thing. I know I'm going to have the same conversations in about a month from now. We prepare our traders, we talk about this with our traders, but in the end, we're all human. And I know I'm going to have these conversations. But for those of you who can see this in advance, there's a lot of things you can do to help it out.
And I want to point this out too. These are professional prop traders we're talking about. So if you are somebody who isn't quite there yet, and you think that these people are all super disciplined and know exactly what to do, and that's why they are what they are, even they have the tendency to fall apart here. So this could be just about anybody if the people at the very high levels are falling for this as well.
And let me jump in and just say that this is really an issue with my discretionary traders. Everyone runs different systems at Maverick. Some people are purely programmatic. Everything is done on a program. This affects them very little at all. The people that are more discretionary, this is going to affect them more. So I really want to talk to each one of you individually and talk about if your trading has some discretion in it, you are much more likely to fall into these traps than someone who is purely programmatic.
Well, here's where I want to come in too, because I think that even though, most of my traders are, I guess, they're discretionary, but they're also, they follow a very specific system that tells them when to go. So you would think that you wouldn't have these issues like somebody who doesn't run a system like that. However, I still think it happens. And here's my case for that, right? So you've kind of tackled the emotional side of it, right? So even if you go the logical side, this is something I covered in my podcast episode, my investing podcast a couple days ago. It is known because we've seen it before, and we know his archetype here. Donald Trump is going to want a weaker dollar, and we've seen before that even without support from Congress, he was able to make that happen, especially early on. So it would be logical to think, Rob, that if he does win, that I should mostly be looking for dollar shorts as opposed to dollar longs. Because, now I want to kind of challenge you on this, Rob. I want to get your answer here, because I think there is a little bit of logical sense here. Even though I don't think it's right, I do see the point. If you look at what's been going on the last 10 years in Japan, was it probably not in your best interest to go long only on the dollar yen? Don't you think your bottom line would have probably been better served? And if we're going to have Trump here again, who is really interested in killing the dollar, so trade can go up and so the economy can continue to go up, wouldn't just my non-emotional side, I just want to make money and make the right kind of trades and make the right decisions, that side of me, am I wrong to have this particular type of bias? Because on paper it seems to make sense.
I love that question, and this is going to go way deeper than you expected on this. Whenever we make a trade, whatever trade we make, we are making it with, I call it a premise. What a premise is like a hypotenuse. No, sorry. Yeah, not a hypotenuse. It's a hypothesis where we're looking at the data and we're saying, okay, based on this data, based on everything I can see out there, I believe that this is the most likely thing to happen. Every trade starts with a premise. You have to have a premise of why this is going to happen for you just to build your thoughts and shape an actual trade with entries, with exits, with all this. It's all based on a premise. So all those things you talked about, it's simply another input into your premise. Here's the problem I see is that a lot of times people will take these political biases or ideas of what should happen, and they ignore the actual trends and the actual price action. So at Maverick, we always say, look, every single trade starts with a premise. You basically are going to list out all the reasons why you think this trade is going to go in your favor. Then you're going to plan out, what am I going to do if it goes against me? And then you plan out, what am I going to do if it goes for me? That's the premise you build. So as long as you follow your stops, your targets, and all that stuff, and you follow your plan, it's great because guess what? Sometimes your premise is just wrong. So everything you just said, Patrick, so let's say Donald Trump wins. Let's say he puts the tariffs in place, which is really going to hurt our dollar. And let's say the dollar, some reason, doesn't go down. You can't supersede the price action because of your bias. So that's the only thing I see wrong. It's an absolute input into your trade, but everything else has to be there. And guess what? If you're wrong, you took your small loss and you move on to the next one. You clear the slate and you do a new premise. So that's exactly, we do every trade along these lines. We take in inputs, we build our trades, we plan when we're wrong, we plan when we're right, and we just keep going and going and going.
And that was a great answer. The big counterexample, at least in the Forex world, is the dollar yen. And that was a situation that was just absolutely terminal. And no matter what happened, it just never went their way. Even when the Bank of Japan stepped in and said, okay, enough, it's over. It made a bunch of news, but over time, the trend just kept going upward for the dollar yen. And we had a good 4 or 5 years to see that before we really said, okay, this is just kind of how it is. With this 4-year election cycle, you're not really going to get the chance to see that. And like you said, Rob, a lot can happen in the meantime. What the president wants is just what the president wants. Just because he got his way for a good year, back in 2018, does not mean we're going to see a repeat of that. So even though X does typically equal Y in these situations, it's not the only equation on the board. There are other factors at play too, and other really strong factors as well. The Federal Reserve, for example, what goes on in China, for example. There's a lot of different factors at play here. So you can't just sit there and say, if this candidate wins, I'm going to be looking to take these types of trades and these types of trades only because I feel like that's going to give me an advantage. You might be rewarded, but you also might not. And I would really hate to see external factors like this get in the way of what should be a pretty good and efficient trading system.
You are exactly right. And that's what it really comes down to is that, are you acting in objective ways? Are you following the data? Are you following the trends? Are you following your indicators? And yes, you can absolutely mix in some of this fundamental analysis. I think we talk about it all the time at Maverick of, hey, this is why we think that X is going to happen. That's just trading. That is trading in a nutshell. But what we do have to recognize is that a lot of these subjective things in our bias are going to get into our trading. And that's what a lot of our episodes have been about, is about these biases creeping into our trading. So to really try to guard against this in this economic cycle or this election cycle and the next election cycles, I want you to tell yourself that your biggest political allegiance is to yourself and your trading. I saw an interview on Chat with Traders, and the trader, he was great. He said, my only bias is trying to be on the right side. I love that, and I think if you can get your mind and your world of trading to where your greatest allegiance is not to what's happening with Republicans, Democrats, independents, your biggest allegiance is doing the best job you can of following your system, then you're going to win. It's going to be compartmentalizing your political bias, because you can still be a very strong Republican. You can still be a very strong Democrat. and you can still take a trade. Like one of the stocks I've been trading lately, and it's only because I want to prove that I am non-biased, is I've been trading DJT. I've been trading DJT long and short. And I've been doing it just to show it's a great mover in the first place. But I want to show that, hey, I can do both. Regardless of my political biases, you can do both. If it's going up, I'm going to go long. If it's going short, if it's going down, I'll be short. That's where you want to get to where it just doesn't matter. Your allegiance is to being on the right side.
And can you explain to everybody what DJT is and what it contains?
It is a Trump Media stock. So Trump Media owns True Social, and it is a very volatile stock. It is, yeah, it's crazy. Go take a look at the chart.
But this really ties back to what I was saying about sports, too. It's funny how the older I got and the more I separated myself from being identified with certain teams, what really mattered to me at the end of the day is which team made me money. And that's really, I think, a pretty good tie-in to this entire episode, as kind of crude and rudimentary as it is, yeah, my biggest allegiance at the end of the day was to myself and the money I was making. Just like you said, with your biggest allegiance to be to yourself and your trading. Anything else we should wrap it up with here, Rob?
No, I think if you just remember that, and if you need to, when I was a young trader, I got a label maker and I put labels all over my computer monitor. The computer monitors don't have as much of a margin anymore as they used to, so I don't have any labels on mine anymore. But the old big monitors, you had a lot of room. I would say print out something like, your biggest allegiance is to yourself and your trading. Just keep that in your mind, and I think it would do just fine.
Because look, at the end of the day, and I will edit this out if you don't want it in, Rob, but you guys probably don't know this. Those who listen to my investing podcast, you know what side of the fence I'm on politically. Rob is on the opposite side. Rob and I are on two very opposite sides of the political fence. And so normally in real life, if you would see two people on different sides, you would see them disagreeing on a lot of things. And maybe Rob and I do about, things in everyday life. But isn't it funny how for 76, 77 episodes now, we tend to vehemently agree on almost all the same things at the end of the day. Isn't that funny, Rob?
It is funny, and I actually think I feel the same way about my team in politics that I feel about my team in football. I haven't picked great teams, not because I loved them, so there's really no strong allegiance to it. So, like, I'm on a certain team at the moment, but gosh, I want to get out of the team so bad and just back to the middle.
Yeah, but like I said, at the end of the day, our biggest allegiance is to ourselves and our families and our bottom line and our trading and our overall well-being, and we all agree on the same things. That should tell you something. So thank you for joining us here on another episode of the Trading Psychology Podcast. Rob and I will see you next time.
Goodbye, everybody. Go vote.
This is the Trading Psychology Podcast. This is VP, creator of No Nonsense Forex and author of the book No Nonsense Forex Trading Psychology. And with me, as he is every week, it is the Oracle of Northern Utah. He is Rob Reinhold.
Well, thank you, Patrick. And Oracle, again, these just keep getting better and better. I don't even really know what that means, but I know it doesn't sound derogatory, so I will take it.
Yeah, I'm not 100% sure either, but I did think it sounded good. Now let's move on to this episode. So, you guys kind of seen the theme of what we're doing lately. We've talked about all the major concepts there really is out there in trading psychology, at least ones that we're really aware of. So what we're doing now is talking about specific instances, specific things that maybe have happened to you or a certain mentality you might have. I did this in my book, separated them all into instances, and I was just hoping that they would hit. Like if I have 18 of them, 3 or 4 of them hit with you, and then you always have something you can go back and reference. And so we're going to attempt to do that today, and we're going to do it by pointing out, and this will be part 1 of a 2-part series. So, Rob, I'm not sure how long this is going to go, but it's going to be a 2-part series talking about the things we notice with our traders that even though they should know better, they just don't. And how do we, 1, identify it, and 2, overcome it?
Wait, we're doing this to help people? I thought this was just us coming on and airing our personal grievances.
In a perfect world, I think we could just do that ad nauseum for like 2 hours. I think it would be great theater. But we got to keep our eyes on the prize here, Rob.
All right.
So what we are going to see, I have one, Rob has two, and then I'm sandbagging one for next episode, and I think Rob's got a couple as well. But it is kind of hard to believe, though, Rob, at your level, at prop firm traders, even prop firm traders who have been there 3-5 years, maybe even longer, they're still doing things that irritate the crap out of you. Is that true?
Yeah, that is true, because all of us are never at the finish line. I mean, it's always a work in progress. I definitely have to deal with them much, much less than I do a newer trader, but those issues still always creep up a little bit.
And when they do they typically come to you with it, or is this something you notice from afar and are able to kind of recognize it and diagnose it and approach them?
No, it's definitely usually they come to us saying, hey, I've got this issue, I've got this issue. Every now and then, yes, I'll reach out to someone and some of these will come up in our discussions. But for the most part, we always like to have some active dialogue with our traders.
Okay, so on that note, go ahead and start us off. Like I said, we'll do a little quick rotation here. And this doesn't have to be your number one, but just the first one you care to discuss today of an issue that still happens with your prop traders that just bugs the hell out of you because they should know better, especially at this stage.
Oh, this is my number one for sure. This is the number one, and you're going to hear it in my voice. And look, whenever I'm having a discussion with a trader and they're saying something, I'm listening to them, trying to calculate or contemplate what they're saying. If I hear them say this, I immediately, completely override them, completely butt into wherever they are in their sentence. And I say, absolutely not. You cannot say that. And it is the phrase, I know. Again, they could be talking about something, and the second they say, I know, the discussion is over. Well, it's not over, but it's on hold, because those words are the most dangerous words a trader can say to themselves. We've talked about this in one of the other episodes, and the saying that we brought up was, you don't know shit. And so that's what I say. When a trader says, Rob, I know, boom, I jump in, whoa. You don't know shit. That's the number one pet peeve of mine.
So, okay, well, give me some context here, Rob. Like you might say, hey, it's a nice day outside, and I say, I know. Now, that doesn't mean anything, but when they say, I know, what are they referring to? What are the other words around this sentence? What exactly are they saying, I know about, that irritates you the way it does?
Right, thanks for asking that question, because yes, I did not narrow this down. When a trader says they know something is going to happen in the future, that's what I'm talking about. So they'll say things like, Rob, I know it's going to bounce at support. Rob, I know that it's when the McClellan oscillator gets to a negative 37, I know it's not going to go any lower. Whenever they say they know something that's going to happen in the future, I jump over them and say, absolutely, you cannot say those words. And it's not just because I'm trying to be a jerk. When you say those words, your brain does something different with those words than with words like I think, or odds say, or most of the time. Those are different phrases, and all those phrases are okay to use because it gives your brain this idea that, hey, you know what, it's not a guarantee. There could be some situations where it doesn't do it, so I should probably start to plan on those situations. When you say I know, you have completely eliminated all the other possibilities that are real possibilities, and you don't spend any mental energy thinking about them because they don't exist in your brain. That's why I just am so serious about this. The second you say I know, your brain eliminates all those other possibilities that are real possibilities, and you no longer need to think about them or even consider them. That's why those words are so dangerous.
I mean, this almost sounds absurd to me because especially somebody who has experience, like why would they say, I know it's going to bounce off support? Have you not seen support fail enough times in your career to where you stopped speaking in definitives? It just doesn't make a lot of sense to me. It's almost like a rookie mistake. Somebody will come up, like a price action trader or somebody who's trying certain indicators for the first time, let's say like a moving average, okay? And they're getting killed in a short, but they're like, well, I know that at some point it's going to come back and regress to the mean, which means it's going to come back and touch that moving average. I'm like, well, yeah, but do you know how high that moving average can go before that happens? You'll be completely wiped out. Now, that person's not wrong. There will come a time where price will come back and touch that moving average. But they're missing the larger picture here. That part I could almost excuse. A situation like you're talking about, Rob, I mean, tell me, why do you think this is happening? Why do you think this is such at least the way you're describing it, maybe I'm missing something, it's just such a boneheaded mistake to make in your head. Why are people, professional traders, 3 years in, making mistakes like this? Let's break it down some.
That is a great question. And one little wrinkle to this is that most of these conversations where I get the I know, they are also risk management calls to where a trader is in a tough situation, where their back is against the wall. Now look, they've done other trades perfectly great, and they've stuck with their stops, they've done everything they should, but they've blown this one. And they've got a risk management call. So when I call them and be like, hey, what are you doing with this position? You've really effed this up. They don't want to get out of that position because now it's a bigger loss than it should have been. And the fact that they haven't gotten out of it yet tells me that they're stuck. And I don't know if we've ever used that term on this podcast, but I call traders all the time and said, look, I know you're stuck. I've been stuck myself. I get it. I understand it. When you get stuck in a trade, you literally just can't get out of it. You know you should. Everything in your training and everything you've read and studied tells you should. You know you should, but you just can't do it. And so you have to then go into your technical analysis and find some justification for why you have broken your rules. And then you grab onto whatever that is and you say, oh, this is how I can still stay in this position, not take the loss that I should have taken a while ago because of this, whatever it is. They pull a rabbit out of the hat. They pull a McClellan oscillator. They pull a Williams, whatever. I mean, they pull anything out of a hat. And it's all because they've put themselves in a situation where they now have to justify their bad behavior. So I'm glad you asked that question. Most of these times it happens on a risk management call. Very rarely will it just be on a random trade. They're like, oh, it could win, could lose. They never say, I know about that. It's always when they've blown it and they need to justify their bad behavior.
So if it's okay with you, Rob, I want to take this even deeper because now I'm getting even more fascinated about this because what you kind of said before about how they feel stuck. Now, let's tie this back over to people who are maybe just home traders, for example, because I think there might be parallels to this mentality. So stay with me here. You hear a lot of people who, quote, lost their ass in the stock market. All right, now we all know stock markets go up for a very long time, and then they take the elevator down. But it's not a bullet train elevator down, if that makes any sense. You usually have time to get out. It's not one daily candle that just goes all the way down to the bottom. There's a point in time where all these people who, quote, lose their ass in the stock market, they were down, 30, 40, 50%, and they had decisions to make, and they probably should have cut their losses and reaped at least half of their bankroll back. But they stayed with it. Even if we're talking about something like Enron, for example, that was just embodied in a huge scandal, like, what is going on with these people? Why do you think they allow themselves, one, to get stuck, two, will not allow themselves to get unstuck?
It's a great question, and I think that would be a great episode because there are a lot of reasons. And for you to understand, like, the psychological reasons, I also use the term deer caught in the headlights. You're the deer caught in headlights to where you don't move. The car's coming right at you, but yet you're in this situation where you can't move. Getting stuck, it's got a lot of reasons to it. And I've been stuck before. I remember back in the days, I was stuck. My phone.com trade that I think I've talked about on this podcast, I got stuck. I got stuck in it. I literally could not hit the sell button, even though, it was a short, so I could not hit the buy to cover button to save my life. I was only able to be forced out by margin calls. That happened back in 1999. Patrick, have you ever been stuck in a trade?
Yeah, let me go and remind you, I was a penny stock trader before I was a Forex trader. Yeah, that's pretty much the definition of that industry, is you get stuck in these trades, and it's up to you just to eat it or to hold on to a little bit of optimism. Whatever, you latch on to whatever's there. But no, you're right. I don't want to go too far with this because I think you came up with a good idea, and that is we should have an episode on this because I think a lot of people can really relate to that. I always wonder how, percentage-wise, how many people can relate to some of the things we talk about nowadays, but I think that's a big one. So let's kind of hit the brakes on that and make a nice smooth transition because mine, the one I'm bringing to the table today, I think has a little bit of the one you just talked about, and I also think it has a little bit of the one you're about to talk about later. So allow me to use this as a bridge. And mine that I've noticed, and I see this more on Twitter, a little bit on Discord, not so much in the YouTube comment section. I think people want to keep this one under closed doors. But a pet peeve that I see is when people deviate from their system because of a very bullish or bearish news event, like a one-off news event. Not something terminal like Enron, not something terminal like the Japanese yen. More so like, okay, if they're in a long, well, there's people talking right now that the United States might have a sovereign Bitcoin fund and start adding $200 billion a year, whatever, to it. And look how bullish that is. I can't take profit on my Bitcoin trade now. I can't take profit on my Bitcoin investment now, even though it's 4x, 5x, because maybe we might have something. I mean, that's pretty major. The United States government is going to buy Bitcoin every year. I can't stick with my system now. I mean, look at this big news event that might happen. So there's that. And then it happens on the other side too. It's like, oh, well, we just had, the SEC just came after, this particular crypto, for example, or war just broke out somewhere in the European Union, or the EU's having an issue with like back with Brexit, things like that. These one-off things, and they justify this as a reason to just sit there in that trade or that investment for freaking ever. There is no end time to this, and I don't know. This is how they justify it, and it absolutely drives me crazy. Do you have any experience with this at all, or is this just me kind of talking to myself in my own head?
No, I've got plenty to say about this. I'm going to go all the way back to late 1999. Late 1999, we had, the dot-com bubble. Now, of course, it's very easy to look back and say it was a bubble, but at the time, look, it was pretty clear it was a bubble, but not everyone believed that, so I'll give people a break on that. Things were foundationally changing. And just think about how big of a change it was in society. This is like a once-in-a-lifetime kind of change in society. And so these stocks that people were buying, that were doing revolutionary things, it was amazing. And the stocks went up, 1,000%, 2,000%, 3,000%. And there were a lot of people that never sold. They never, ever, ever sold because of this belief that this was going to change the world. And now they were right. But guess what they were not right about? They were not right about their .com company ever being able to be profitable. And so they allowed this major shift in technology to basically override sound trading and investing principles. Now, we see this a little bit in AI. We've seen it in some other areas. Look, The whole point is you follow your plan. And anything that causes you to deviate from that plan is a mistake. This is just one of those mistakes that can happen where something, a one-off is a great example of this. Just some big news one-off happens, and all of a sudden you bail on all of the hard work you did to put into building this trade. You just bail on it because of this news. And what happens is sometimes that news works and sometimes it doesn't. And then what happens is you get stuck in those trades. Those are the trades you get stuck in because you can't admit, now I should go back to being a good fundamental trader and follow all my rules. You can't go back to that because you already blew it. So now you got to justify why you're staying in it. And in 2000, we saw people ride millions of dollars back down to the zeros. And then that just happens on these kind of things.
Yeah, this is why it ties into what you said before. That's exactly what I was thinking. And I think what really irritates me about it, and I don't like saying it in these words, especially in my Forex material, but especially because I know where a lot of traders are starting from. But this is such a scarcity / poverty mindset. This should not be your 8 Mile. This is you're treating it like this is your one chance at riches and greatness. And it should not be. You should have a lot of irons in the fire when it comes to trading and when it comes to investing. And okay, maybe if this is the only trade you have on right now, okay, you know as well as I do, if you're a Forex trader or a crypto trader or a stock trader, there's going to be another bust coming probably tomorrow, if not 2 or 3 days down the road. People are treating this like their one and only shot. And that's what I think really irritates me, is they haven't figured out that it's really, none of this is about anything. None of this is about that at all. Trading is all about distancing yourself away from this whole one shot, one kill mentality.
I remember as a young trader, this is like back in 1997, 98, I was watching this new network called CNBC. So again, the stone ages of trading. And they would always interview this guy. He was in the pits. He was in the trading pits. And, everyone's yelling and screaming, and they put a microphone in this guy's face. And he's like, oh my gosh, I've never seen this kind of carnage. This is the worst thing I've ever seen. We're selling everything. And I'm like, oh my God, this is crazy. And then literally the next day, they talked to him, put a microphone in front of his face. Like, you know what? I'm feeling pretty bullish at the moment. I think things are rising. And I'm like, what? What just happened? But as a young trader, I didn't have the experience to understand that everything's cyclical. And one of my favorite people in the world, and I'm glad he is still alive at this moment, is Art Cashin. He's my favorite guy on CNBC. Art Cashin has been there since like 1950. And I remember during the financial collapse of 2008, I had never seen anything like that. I was like, oh my gosh. Like, I've been trading for about 10 years, and I'm like, oh my gosh, like, is capitalism going to survive this? Are the stock markets, is every stock going to zero? Like, we didn't know what was going to happen. And I remember they brought on Art Cashin. And he was cool as a cucumber. And he said, you know what? This happened in 57. This happened again in 63. We saw it in 82 and 87. You know what? Yeah, it's going to be ugly for a while, and then it's going to bounce back. And that gave me some calm. I said, oh. And I also was reading a book called A History of Panics, Manias, and Crashes. Boy, that is not the right title of the book, but I'll get the right title here in a second. And it's a book about all the crashes that happened over the last 500 years. And do you know what I learned when I read that book? It was just temporary. That was it. Yeah, now sometimes it lasted 20 years, but in the grand scheme of it, it's all temporary. And as now I've been doing this for longer and longer now, it's much easier not to react to those news events because you understand once you've lived a long life, like everything, you've seen everything happen, and you realize there's no reason to overreact to any of it. It's just normal cyclical behavior.
All right. Well, Rob, if I'm going to ask permission to do this, but may I take you to task on something here in front of all of our wonderful podcast listeners?
Absolutely.
Okay, so this is something that you and I talk about off camera. People listening right now might not know, but in terms of our outlook on the overall economy, which, it's just our opinions, take it for what it is. I am in the hard landing camp. Rob is in the no landing camp. So given what you just said, Rob, and all these things we're hearing right now, just the fact that the word no landing is even being floated around right now, and these quotes like, oh, the government has made recessions illegal, and we are approaching the AI revolution. This is all textbook, top of the market talk. And we get so caught up in these words and phrases sometimes that it isn't until after everything already crashes we look back, just like we did with the dot-com boom, and say, oh, yeah, but we forgot this one really important thing. Those stocks weren't worth anything. They were selling market share. They weren't giving actual money to people. They were giving market share. And it was absurd. But the idea at the time sounded revolutionary and sounded brilliant. And then only when it goes all wrong do we kind of finally see the absurdity of the whole thing. So to me, it seems like that's what's going on right now. Are you not seeing that? Do you think that these sayings actually have weight and it's just going to be up only? Because that goes against a lot of what you were reading that book and a lot of what your guy was saying.
I absolutely love this question. I got a big grin on my face over here. So I just talked about that maniac in the trading pit who had flipped from super negative to super positive in a day. And I remember thinking like, oh my gosh, this guy is insane. No, he's not. He's exactly right. And so this is where I am as a trader, is that when the data says to be bullish, and be as bullish as the market says to be. Right now, markets are going higher. And guess what? I'm very happy enjoying the ride. But I've got technical indicators that when they turn, I turn. And you will hear me sing a completely different song when the technicals have turned. So you're not taking me to task at all. I'm just reading the data that's in front of me right here, right now. But I promise you, I will turn faster than you could ever believe. I will be that maniac that was the most bearish he's ever been one day and the most bullish he's been the next day. I'll be that maniac because that's how you trade.
Okay, so it's not that you just don't think there's not going to be any kind of landing at all. You just don't think there's going to be one right now or in the near future, and that's why your chips are where they are. And as soon as that changes, you're going to change with it, right?
Yeah, and the market is betting on my position at the moment. And the second it's wrong, it'll turn. And guess what I'll do? I'll turn. My only bias is to be on the right side of the market. I have no stake. We have a saying in Maverick, we want to be market agnostic. You're market agnostic. You're not hoping for a bullish market, a bearish market, or anything market. Your job is to be on the right side of the market, period.
Okay, good to know. Because when you first told me you were in the no landing camp, I'm like, this guy has lost his mind. Okay, good. No, much.
Look, I'll be in your camp at some point. Again, like I said, I will be that maniac in the pit where one day you'll talk to me about it and then we disagree. And then a week later we talk and I'll agree with everything you said.
And for clarity on my end too, I'm not bearish right now. I think something is certainly coming. Everything is in place. I also know that it always happens when sentiment is at its highest. It never happens when people are dooming and glooming. It happens when you finally have shaken those people out. So whenever that day comes, that's when you should really be careful. And yeah, I announced this on my own investing podcast in the spring, when I entered a QQQ trade. I'm like, look, we know things are coming, but they're not coming now, and there's every reason to be bullish. So I've been in QQQ ever since, and I have zero regrets, and I'm hanging on to that sucker.
Patrick, this reminds me of several times, and I totally agree with you. In my life, where I'm like, oh, the top is close. Like when a cab driver starts telling me about all these investments that I should be making. I remember that back in like late 99, I was in New York, and the cab driver was telling me about all these tech stocks that I should be buying. And I'm like, oh my gosh. Or like the bagger at the grocery store was telling me about it. Do you remember back in, I want to say it was like 2006, that people were refusing to be paid in dollars and they wanted to be paid in euros? Do you remember that, Patrick?
I remember some actress came out and said, pay me in euro. And that's all I remember. And in my mind, I was...
Yeah, there were some actors, and there were some models. They were like, no. So where do you think the absolute bottom of the US dollar was?
It had to be right there because, even I was looking at that at the time. I was like, dumb. Yeah, don't ever, no.
That's a great sign. If you want a good sign of when the tops and bottoms are, is when, I'm just going to say it, when your dumbest neighbor starts to give you financial advice. That's the top and that's the bottom.
Yeah, and it's so funny because in crypto right now, you see condensed versions of this, and they always hold true. Whenever you get a big run in meme coins, you pretty much know that the end is near because, well, honestly, it's kind of weird now because usually back in the day, only dumb people were in meme coins, but now it's pretty much just OG crypto people who are bored and are looking for some alpha that get into meme coins. But either way, that usually signifies a top. Usually when celebrities come out with their own coin and for some crazy reason it actually does really well, things like that. And when mainstream media starts talking about this paradigm shift that we're having now into a digital world, again, that's great and all, but it almost always signals a top. And I want everybody to be very careful about this. When you start hearing these really ultra bullish things on the future, call me a conspiracy theorist, Rob, call me whatever you want. I think that is big money saying to everybody, we are getting ready to dump on you. And we want that last little push so we can go ahead and do what we need to do.
It doesn't matter why it happens. The fact is it happens. But I want to bring this full circle back to your point of not overreacting. Because, again, I started to become cautious. I started to take less trades. And I felt like an idiot for about a month because everyone else was making all this money. But all my indicators, everything was telling me, lighten up. You don't want to be too heavy, be very nimble. And I was really happy with it that I stuck with it. So it's just stick with your system, stick with all the work you put in. And yes, at times you're going to look dumb, but I promise you, at these moments, that's closer to the top and bottoms than any other time.
Yeah, and look at the bright side. At no point in time are Rob and I ever telling you to take everything off the table. We're just asking you to scale out like a normal, rational trader does, like a normal, rational investor does. So you still have a lot of upside potential here should this prediction be right. But if even taking half off or a third off irritates you to where you don't want to do it, again, you are trading like you're poor. I don't care if you are poor. You're not going to trade like you're poor because poor traders don't make money. Full stop. You got to do it right. You got to do what the rich people do. And we're doing our best here. All right, Rob. So let's go ahead and transition. So if we've gone so far off the reservation here that you've forgotten what the last one was overvaluing very bullish or bearish news events and not getting out of your trade or scaling out of your trade, I should say, as a result. And so this one I think transitions nicely into your last one for this episode. And go ahead and fire away with that one.
Let me really share with you how long I've been trading because, as I've said, I traded in the Stone Ages of trading. Had one monitor, a 14-inch monitor, and to add another monitor was like $1,000 just for a dual memory card. It was crazy. It was crazy to have two monitors. But when I started out, there was no such thing as a stop order. There was only market orders and limit orders. That was it. Those are the only two orders that you could possibly put in. You could put in market or limit, and you could do good till canceled or good for the day. Order entry was very, very simple. Very simple. That's all you could do. So there was no way to put in a stop order. Now, there was the concept of a stop order, and everyone understood the concept of a stop order. And so we, obviously as traders, like, okay, if it goes down below 50, I'm going to cut it. But you had to have what we called a mental stop because there was no actual stop order to implement that. You had to have a mental stop. Boy, that's the biggest lie that we've ever told ourselves as traders. The biggest lie is that I'll get out if it breaks 50. Now look, you'll get out most of the time, when it breaks 50, but I guarantee you, absolutely 100% guarantee you, you will not get out every time, because all the psychological stuff we've talked about on this podcast, they'll all get you. Every single little one is going to get you. Greed, fear, what happened in your last trade, what happened in your last 5 trades, what's happening in your personal life. It's all going to affect you at that moment. So my biggest pet peeve is when I look at a trader's account, I see positions that are not limited risk positions, but positions that have lots of risk. And I'm like, hey, I don't see a stop. Where's your stop? And they tell me, don't worry, Rob, I got to stop here. And I'm like, where is it? Why isn't it in the system? Why is it not in the system? And they say stuff like, well, I don't want it to come down, and have a wick on that, at that $50. Let's just keep that $50. I know if it might go down a little bit below 50. Oh, there it is. I know it might go down a little bit below 50, but it's going to pop right back up. So I don't want to have an actual stop there. No. Have the stop in there. That is your best chance to actually follow your system. So that's my second biggest pet peeve, is people that tell me or think that they're going to get out at a certain point and think at that moment, with all the stress, with all the prior things that happen in your trading, that you're going to do it 100% of the time, because that is just a flat out lie.
This is such a good one. And you said it before I could say it. This mentality right here opens up the gates of hell for every single trading psychology issue one could ever have. This, what you just said, enables the absolute worst of human trading psychology. Something like this, having a mental stop. And it's so funny you said, the reason why they didn't want to get wicked out. Okay, yeah, fine. Well, here's the funny part, is before a wick forms, a big, huge bearish candle forms first, or is forming. And that might be all you see. Now what are you going to do? You don't know that's a flash crash. You don't know that's just going to be a wick down. That could be the beginning of something far worse. So what kind of decision are you going to make there? Are you going to be in the right headspace to even make a decision like that? Probably not. So just, God damn it, let the system do it for you. That's why it's put in place. And it's funny too. Like, I'm disappointed that this is happening with traders. I feel like this would not happen to most traders, because if it did, they're not going to last. They're going to have their accounts blown out. They're going to quit. I think people who have been doing this long enough trading should know to never, ever do that. However, the investors out there, and I know there are 10-Minute Contrarian investment podcast listeners listening to this episode right now, and let me tell you, I will bet half of you motherfuckers are doing this shit right now. You have mental stops on the investments you have, because you're so long-term bullish on them that you're probably just going to stay in them no matter what, that you have absolutely punted any kind of sound money management along the way. Even if you did what I told you to do with take profit, write it down, put it on a spreadsheet somewhere, I'll bet you half of you don't even have a stop loss cemented into any of your investments right now. I will bet that's the case. And if anybody wants to come out and say it in the YouTube comment section, if you have the balls to do it, go ahead. But Rob, if I had to put money on it, I would put the over-under at 50% of even my investors who I drill this into their head. I'll bet they don't even have a stop loss. How do you think this pertains to investing? Do you think it's better or worse?
Before I jump in to answer that, I love what you said, and we need to, again, we've talked about putting trading shirts, trading merchandise out there, opening up the gates of hell to everything wrong with trading psychology. It's so true. It's so true. Not having a hard, fast stop in there, you are opening up the portal to hell of trading psychology. That's what you're doing. And it's going to get you. It's going to get you every single time. You will absolutely get stuck in these trades. There's just no way it can be any different. That's just a guarantee. All right. I actually forgot what your question was, so remind me real quick.
No, that's okay. Yeah, so we're going to add to our merch collection. We have a shirt that says "Work hard, trade harder," and then we have our "Open up the gates of hell" shirt. Cool. We got two. That's a good start. Now, my question was, do you think people are making this mistake even more so with their actual investments as opposed to their trades? Because there's such a more kind of laxed discipline with investing than there is trades, because with trading there absolutely has to be, or else you're going to flame out right away.
Yes, and there's actually two reasons for this. Number one is you typically put in more time, work, and effort into choosing an investment than you do a trade. So, and we've talked about this in previous episodes. Let's say I, as a trader, spend 10 hours researching one company. I go through, I know all the names of the CEO, the CFO, I know their pedigrees, I've gone through all the company reports, I've gone through all the consumer reports, and I know everything about this company, and I've determined that it is a great investment. When I click that button and I get in, I now have a lot invested, and I'm not talking about money, a lot invested in the success of this investment. Now, if I then go out and tell my neighbor, hey, you should get into this, I've done all this research, you should get into this too, and your neighbor goes out and buys it, you now have even more investment in this being good for you. And now you got your neighbor. If you have a big platform like VP does, and he tells everyone, hey, you should all buy this, talk about absolute investment in this trade or investment, whatever you want to call it. You have now made it so absolutely difficult for you to recognize and realize and admit that you're wrong, because now you've got a lot riding on it. For any of you that saw my Flat Earth Trading Society, one of the best things about that experiment was I was flipping coins. I was doing Scrabble tiles. I had no idea what some of these stocks or positions even were. All I knew was they were a symbol, and you flip a coin, you go long, you go short. That's it. All of a sudden, it makes it very easy to admit you're wrong because you don't have all of this invested. So I think the more time and effort you put into a trade or investment, the harder it's going to be for you to be able to put in a stop and admit, hey, I might be wrong at this point. And I think with investing, you tend to do a lot more research before you would looking at dollar yen on a 1 hour chart. You know, that's a pretty quick decision you could make. But investing for something over 3 to 5 years and doing, some buying along the way, you have put in so much time and effort. It's going to be it's going to be so hard that why would you even put in a stop? Because you're so sure about it. You've got so much invested. So I'm 100% on board with you on this.
So I want to see if you're also 100% on board with what I'm about to say here. And here is the one exception I will say to what you and I both just got done saying. And you have to do this a specific way. But with crypto, all right, I feel like you can approach this a little bit differently because of the absolute asymmetry, because of what these things could be, not just from a currency standpoint like Bitcoin, but from a company standpoint, right? If you, and we know how volatile these things are, and things can go down 30% for absolutely no good fundamental reason, right? So if you have your allocation to crypto spread out across enough of them, I think in certain situations, like with me, mine is with Bitcoin and Litecoin. There's a finite amount. I think that makes it completely different than everything else out there, and I want to see where this goes. So the money I have chosen to allocate over there is just simply going to stay there. And because my money is spread out into so many other different tokens as well, I really don't care if I lose that money. I don't care if it does go down to zero. Now, I don't hold the same thoughts with my actual stock investments. I practice insanely good money management there on the downside and the upside. But sometimes with crypto, and especially in those two situations, I'm actually letting those two ride. And I've publicly said this. And I feel weird about it because I preach this other thing over here too. Do you think given the situation I've drawn out for you, or given the scenario I've drawn out for you, Rob, that it's actually okay to do? Or do you think I'm being a big hypocrite? If I'm going to do things one way, I should do them that way across every investment category, no matter what it is?
Not at all. Not at all. Look, on a long, everyone has a stop at zero. So everyone technically has a stop. On a short, you don't. On a short, you can lose more than 100%. But on a long, everyone has a zero. And in my world where I do a lot of options trading, we position size options spreads and options positions for max loss, meaning zero. Like zero is the stop. We're saying we're going to invest $1,500 in this, and the worst it will be is a zero. That is our absolute stop. So it comes with a built-in stop at zero. As long as it fits within your plan, as long as it fits within your allocations of money management, and you say, I don't have too much in any one of these positions, you have a stop at zero, and you just have to clearly define that in the beginning, which is exactly what you did. My stop loss is zero on this. So because it's zero, I'm going to make sure that it's a very small percentage of my overall portfolio, because I realize that zero can happen, but I think it's very unlikely to happen. So no, it's a very valid argument to have a stop at zero. It's actually the best way to get an insanely big gain, especially on a volatile product like crypto.
Okay. I feel a little bit better now because I do have stop losses on most of my crypto. There was one that went all the way down to zero before I could even notice it. I've done a blog on that. It was a long time ago. But I've had so much, gratefully so much success with crypto that nothing since then has really come down and hit my stop loss. I will admit I came a bit close with Polygon, but thankfully it's back on its way up, so I feel better there. To clarify what I'm saying, I think in the stock market, you really need to have a stop loss somewhere. With crypto, depending on how you do it, you can be a little more fast and loose. If you only have 5 positions, don't do that. If you have closer to 20, you have a little more latitude there, bottom line. So, okay, Rob, I thought this was going to be a 20-minute episode. It's gone 46. Say a prayer for me when I edit this tomorrow. But are you ready for part 2?
Yeah, absolutely.
Well, until then, thank you, everybody, for joining us here on the Trading Psychology Podcast. And Rob and I will see you for part 2.
Goodbye, everybody.
This is the Trading Psychology Podcast. This is VP, creator of No Nonsense Forex and author of the book No Nonsense Forex Trading Psychology. And with me, as he is every episode, it is the surly Rob Reinhold.
Wow, I must be surly today, even though it's kind of my default. No, that's not true. I'm the most optimistic pessimist you will ever meet.
I think that's fair. Yeah, I'm a little less of a pessimist than you. I always try to stay optimistic, but yeah, we're realists at the same time. And we're going to be a little surly today, though, because we're continuing our series on pet peeves. Yes, traders, there is so much that Rob and I just cannot stand about all of you that we had to break it up into 2 episodes. And we are moving into part 2. And Rob, how do you want to do this? I have 1. You are extra surly, and you have 4 today. So you tell me how you want to break this up, and I'll follow your lead today.
Right. I only have 1 pet peeve, but I have 4 subtitles or subchapters of this pet peeve. So why don't you go first and take care of yours, and then I will try to keep mine to a minimum length if possible.
Okay, sounds good. So mine is not something that really bothered me at first. I think because I used to actually do this. And then over time, I would hear other people say it, and I think it just made me look back and say, you know what, this is such a dumb excuse. And it's not only a dumb excuse, it doesn't get anybody anywhere. And it just doesn't seem like it can ever lead to anything positive. And that is blaming external factors in the market for losses and overall lack of success. So let's take this to Forex. People blaming the fact that Jerome Powell and the Fed are a thing and have been a thing for the last maybe 2 years, maybe 3. depending on how you look at it. It seems like we were just getting out of that really dead period in trading, finally coming into a period where volume was back and we could rely on our charts and they would always tell us where to go. And now here comes extra news that we have to deal with. And the amount of belly aching I heard from this one thing, we could talk about other things too, but I want to kind of harp on this one because I think it's the main one because it really is. I mean, it is messing with our trading. It just is. But Rob, there's always going to be something out there that's messing with our trading. We are never going to get complete blue skies. We're never going to get all green lights ahead. There's always going to be things in our way because that's how Forex trading is and that's how life is. And you cannot complain these things away. And it drives me crazy. I think the real traders out there, just like we said before, we understand what the chessboard looks like. We understand we can't complain if there's a pawn where we don't want a pawn to be. That's where it is. And that's the game we have to play. I'd like to hear your thoughts on this. And what if this or other things like this have come up more than once, with your traders over the last few years?
Well, Patrick, I've been doing this for a long time now. And yes, Jerome Powell is the current villain in a lot of people's stories that they tell themselves. But before that, it was Janet Yellen who was the villain. And before that, it was Ben Bernanke. And before that, it was Alan Greenspan was the person that made everyone's trades go bad. Now, I remember back in, this is maybe late 90s, early 2000s, they would show a picture of Alan Greenspan walking into the Federal Reserve, and they were studying the size of his briefcase. And if it was a thick briefcase, then people were saying it's going to be a cut in interest rates. And if it was a thin briefcase, then that meant that there was going to be no cut in rates, or they're just going to stay the same. Now, can you imagine? I bet there was somebody out there that made a trade based on the size of Alan Greenspan's briefcase, and they lost money because of it, and they're like, that damn Alan Greenspan, why didn't he put more in his briefcase? So look, yeah, it's the current boogeyman, but look, that is trading. There is randomness that we're all dealing with. You can put any name to randomness, but it's your system that has to be able to deal with that randomness, and that was created by you. Do you remember the Alan Greenspan debate?
I don't remember that debate. I can't remember if I was really trading during Greenspan. I was definitely trading during Yellen and Bernanke. But to push back a little bit, I don't remember them affecting the Forex market the same way Jerome Powell has. I mean, you've been through this too. There were certain events that you could not really sleep through, but not pay a whole lot of attention to. And it just really does seem like it's a different ballgame now.
Well, I think the reason it sounds like a different ballgame now is that we've had a very active FOMC over the past 2 to 3 years. But if you take a look back at, from 2010 to 2000 and let's call it 17, all they did was raise 0.25% every couple of months when it was necessary. Like it was very, very boring. But then you could say, well, what about Brexit? And what about Grexit, where Greece was looking? It was something else. It's just a boogeyman. Look, volatility is volatility. Volatility is going to come through any matter of ways out there. It might be a person. It might be a country. It might be a disease. It might be something. Here's the point. Trading is inherently, you're dealing with chaos. And anyone who's tried to model the financial markets, they can get pretty close, but there's always that unknown that blows everything up. And there was a very famous story about a hedge fund called Long-Term Capital Management. And these were all high-level mathematicians, and they said, we did it. We solved it. They built this algorithm back in 98, and it got so big that it almost took down the economies of the world. Take a look into Long-Term Capital Management, 1998, and you'll see that pretty much all the central banks around the world had to cut rates because they imploded, because they thought, oh, we have it so good, and only this one thing that will probably never happen is going to, be the thing that sinks us, and guess what? It happened. So you just have to learn how to deal with this stuff As a trader, if you blame someone else, you're not focused on fixing the problem.
Exactly. And I'm glad you brought up Brexit too. That was the big excuse back in the early 2010s as well. Well, I can't get anything done, especially if I'm trading the Euro USD because there's all this weird Brexit stuff. And to be honest, people were reacting very irrationally to every little minor news story that came out about that. And I even said at the time too, I'm like, who the hell cares if deadbeat Greece leaves the European Union? I mean, it seems like the most inconsequential departure out of all the countries in the EU. But yet people needed something to worry about, and so there it was. Now, apart from things like we just talked about, like the Fed and things like Brexit, do you find your traders complaining about anything else typically that really doesn't have anything to do with trading, yet they seem to point to it as the reason for their lack of success?
Not directly, because, during our training, very early on, I basically address this issue. And I say, look, everything that happens is your fault. Whether you made money or lost money, it's your fault. I know there's things that are outside of your control that no one knows could happen. But you have to take personal responsibility for that, because that's the only way you can fix it. If you don't, then you're always going to be blaming outside. So it doesn't matter what it is. One of the things I do want to bring up that I heard, I don't want to say super recently, but one of the things is that, there are some people who believe that there are forces behind the market that are pushing things here or there and doing it for nefarious purposes. I don't disagree with that. I actually think there's probably some element of truth in that. But guess what? It doesn't really do me any good as a trader to blame them for my stop being hit. It does me no good whatsoever. What I should do is saying, hey, there's these forces at work. How do I trade in spite of these forces so I don't get knocked out at stops? That is a healthy way to deal with this. But if you just blame them, you're not doing yourself any favors.
You just described my Big Banks video, the one that's done over 3 million views on YouTube. It's what people needed to hear. It's like, look, there are external forces at play. There it is. That's how it's going to be. We've established this. Now let's talk about how to actually use this to our advantage and move forward. And that was the core basis for my entire channel. So I'm glad that was the one video that really got a lot of this started off, because without that, a lot of the other things I talk about wouldn't make sense. But you're exactly right. And so that's a perfect reply to something like that. The reply I give sometimes too is really what people don't want to hear, because then this automatically turns it back on them. I'm like, look, there's a lot of traders out there doing really well. There's a lot of no-nonsense Forex traders out there doing really well. I'm in the green, and I'm still getting emails and tweets and YouTube comments talking about how they just passed a prop firm test, and you can't be trading poorly to pass one of those. So there's people out there doing really well despite all this. Why aren't you? That's the question you really have to ask yourself at the end of the day. Now, if everybody out there was just completely eating shit, okay, fine. You just have to wade through these times, as do we all. But, if you can't sit there and blame certain things when other people are trading really well despite those things.
I want to go even more into a very singular moment in time. So let's say that you were on the wrong side of the trade when some sort of news came out or something happened. You need to understand somebody is just as happy as you are sad because they made the right choice or they were on the right side of it. That's where your focus should be. Understand that not everyone got taken to the cleaners. Some people are going out for drinks tonight because of that move. So the real impetus should be on, what do I need to do to get on the right side of this trade? And if I am on the wrong side, what's the right thing I do to manage my risk so I don't blow up? That is the life of a trader. I've always said the market is like a big wild animal. And as traders, we are on the outside of the cage. And when we step into the market, we are stepping into the lion cage. Anything can happen. Those lions can do anything they want at any time. Now, yes, sometimes they're tame. Sometimes they don't move that fast. Sometimes they're asleep. Whatever. But when you step into that cage, you have to understand that the idea that you have everything under control is such a fallacy. It's such a fallacy. You have to understand there is risk anytime you get in there, and you got to be ready for it.
Yeah, and I've said it many times on my channel. You are going to lose, and lose a lot. You just have to get used to that. When you tell a brand new trader that, or somebody who's back tested an indicator and it did really well, that does not compute with them. When I'm looking real life, this is going to happen, and it's going to happen a lot. And how you deal with these losses determines pretty much everything. So figure it out. Oh, and if you want proof, go back to Rob's Flat Earth Society experiment. Rob, what did you win, like 40% of your trades, and you still killed it? Like that was,
I think it was 41% win-loss.
Okay, so like you lost 59% of your trades, and you still came out on top. And hopefully overall, most people, especially trading, the way I show on my channel, you're not going to take that many losses over the long term. But even if you do, if you simply handle them correctly, things will be just fine. So I guess that's really all we can say to that one. Rob, let's go ahead and move into yours. Give me a little overview on it, and then we'll hit the first point.
All right, thanks. I've been in this business for a while, but not as long as some other people. So I understand there's some people who have been in this business for longer. But I've been in a very unique situation to where, I started out as myself as a trader, started at the bottom, worked my way up, was able to get into this firm, was able to buy out the firm. And now I've been running a prop firm for the last 18 years. And I've been able to travel around and meet many other traders from other either prop firms or some trading banks or anything like that. So I've been able to meet a lot of people in the industry. Every now and then I bump into one of them that's really cocky. And boy, that just rubs me wrong, because I have seen cocky traders, some of my traders, some other traders. And let me tell you what I have always noticed. They go bust. They all go bust because they thought they were bigger than the market. No one's bigger than the market. One of my favorite books of all time is called Reminiscences of a Stock Operator, written by a gentleman named Edward Lefevre. They don't really know. This is an old book, like I think 1930s is when this book was written. And it talks about supposedly America's greatest stock trader, a guy named Jesse Livermore. Now, they've tried to figure out who this Edwin Lefevre artist or author is. There's no record of him, and there's really not a lot of records of Jesse Livermore, but people think that they're the same person. But basically, it's an autobiography or a biography about America's greatest stock speculator from about 1910 to about 1930. And the story's great. It's a wonderful story. If anyone wants to read the book, I highly recommend it. There is nothing in there that you can use in the market today. This was someone trading in a bucket shop in 1910. I mean, off the ticker tape that was coming on, they were writing it up on the blackboard. Again, there's nothing in this book that's going to help you today as far as technical analysis. But the book is wonderful because it shows this person who rose up and killed it and kept getting better. And every time he got cocky, he lost it all. And he did that several times through his life. And the story is, it doesn't say this in the book, but the story is that he died broke and potentially killed himself. It's very unhealthy. It's very unhealthy. So whenever I meet cocky traders, I think, oh, they're just at one of their high cycles. I've seen this before. They're at the killing it part. They're killing it. They're doing great. But I know that if I talk to them in 2 to 3 years, they're probably going to be at the bottom where they've ruined it because they got cocky. Now look, everyone can live their life how they want. And if someone wants to be a cocky trader, be a cocky trader. I don't care. But here's what I don't love is that younger up-and-coming traders are going to look up to that person. And a lot of times these people are the loudest people online, bragging, showing off their sports cars. And yes, I'm not saying they're lying, but what I'm saying is they're at the top. They're at the top of their cycle. And when you just simply follow them 3 years later, they're likely going to be at the bottom of their cycle. And I think it's really damaging to young up-and-coming traders that are looking at this, and kind of saying, that's what I want. You don't want that. You want slow and steady wins the race. You want to be humble. You want to understand that the market can squash you at any time. And I just think it's very unhealthy for young traders. And Patrick, I know you talk about these guys all the time, and they're always guys. Do you have anything to add to that?
A couple things, maybe. Yeah, there's another book, too, that I've read about Livermore called Jesse Livermore, Boy Plunger. It's a strange name, but they explain it in the book. And you're exactly right. Yeah, every time he got too good, he would lose everything. And there's so many parallels to his career and what you and I both teach in terms of money management and trading psychology. If he just had an ounce of those two things at any point in time, this guy never learned his lesson. But he did have a very unique advantage back then. He was super talented at the good part. He just couldn't somehow figure out the other part. And it's like, man, if you could just do both. I was talking to somebody in Discord the other day, and we were talking about his retirement account in terms of risk. And he said there's some things that he doesn't have a stop loss on. And I was like, well, I think you should have a stop loss on most things. Because I said something, I think it was you and I were talking. It might have been our last episode, where I said there's certain things I don't have a stop loss on. And he said, well, there's a lot of things I don't have a stop loss on because of X, Y, and Z. I'm like, that's an easy thing to say because we haven't had a big recession in a very long time. I think once that happens, you're going to be really glad you had stop losses where you may not have wanted to. Because look at Jesse Livermore. Instead of losing everything, what if Jesse Livermore only lost 20%? Or maybe 30%? How much different would his life have been? How much different would his wealth have been? How much difference would there be in his overall happiness? He probably wouldn't have killed himself if that was the case. So it's just like little tiny things you can do that even the greatest investor of all time failed to do can make a really big difference because you're right. Trading, if you've ever traded for more than 6 months, it's the most humiliating thing you can ever go through. It's the most, maybe not humiliating, most humbling thing you can ever go through. Because just when you get cocky, just when I start saying to myself, even if I miss, I can't miss, and I start believing that is exactly when I fall apart. And I even have the right money management. That's when I'll take like 4 or 5 losses in a row, and it will erase everything I just did.
Well, look, Patrick, we've been doing it long enough that we probably, and I'm not going to put you in this, I'll just say for me, there were probably times in my early career that I was a cocky trader, that I was puffing my chest out and be like, oh my God, look at me. But I just hadn't been through enough cycles, up and down cycles, to understand that, hey, you know what? Yeah, it's great now. You're kicking ass, but we know how this works. You're going to cool off. There's going to be a period where then you are under your averages. Like, let's not get cocky when that happens. So when I see these cocky traders, and again, I probably at some point in my early year was walking around with my chest puffed out. I probably said some things that were really lame to other people and boastful. And look, I understand that. But again, when I see these traders, it just kind of reminds me of back then, oh, I hadn't been through enough cycles yet. I still had some things to learn, and that attitude I had was false bravado because it was simply on one of my upswings. That was it. So that's why, like I said, it bothers me because I think it's unhealthy for other people to see that. And that's really the reason it bothers me. If you want to be cocky, be cocky. I probably was at one point in my early career. I'm not proud of that, but it probably happened.
Yeah, just so everybody knows out there, and I'm mainly talking to newer traders because they're the ones who fall for things like this. If you see somebody, any kind of trader, flexing on YouTube or TikTok or anywhere, one of 2 things is going on. One, they either caught lightning in a bottle and they had the presence of mind to take profit, which is good. But that's the reason they have all that money. Not because they're actually good at this. I'm not going to say they're completely lucky. There's a little bit of skill involved maybe in what they chose to put their money down on. But that's where the money, or that's where the wealth, implied wealth, I guess, is coming from. Or number 2, all that stuff's rented and they're just trying to sell a lifestyle that's not even real. Because I guarantee you, take these people you see right now doing any of those things and create a little digital time capsule. Go to a Google Doc or just write down on a piece of paper. Write down these people's names. And then wait until right now, today's date, 2027. And then go back and see if those people are still around. I bet they won't be. They're not actually good traders. Good traders, one, don't spend the profits they make on flashy things. I understand that's how you sell and hook suckers in. And I understand that you probably want to listen to somebody who's driving a Ferrari as opposed to me who doesn't even own a car. I get that. But there's a difference between real traders and absolutely fake traders. And a lot of people in that first year or two, they have the wrong idea about trading because of leverage, and they think it's going to get them out of this hole quick. It's not. That's just the reality. And if you follow those guys, you're going to follow them right down. I don't think I have to really explain this anymore, but there's a reason. I just want to break down the reason why you see what you see. It's not long-term trading that got them there. Certainly not.
And one of the other things that bothers me about these traders, I'm going to talk specifically about Maverick now, is that, we have people submit applications all the time to us. And I talk to my recruiters, and my recruiters have been doing this I've got one recruiter that's been with me for 17 years, another that's been with me for 12 years. So they've been with Maverick for a very, very long time. And the call that they like the least is the person that's been doing this for 15 years and thinks they're hot shit. When I talk to my recruiters, they always tell me these are the worst calls to get on, because you just have to sit there and listen to them brag and say how much they know. And then we've brought some of them on before, and yes, some turned out to be pretty good and some turned out to be pretty lousy when you actually put money behind them. Here's the thing I found out. Those kind of people are not willing to learn new things. And that again, the market's always changing. The market's always changing, always being more dynamic. And if you don't have that thirst to learn new things, you will get passed by, and your system that you may have had years ago isn't going to work anymore. We have people that are former floor traders on the Chicago Board of Options Exchange, yet they haven't ever traded online. It's a totally different ballgame. You have totally new skills, but they think, I don't need to learn new things. I used to trade on the floor of the CBOE. Yeah, guess what? It's a totally different world. So I find that these people are not humble enough to learn new things. I love when we bring on a new trader that has a new strategy that I've never seen before, and they'll turn in their trading plan to me, and I'll look over it, and I'll be like, boy, I don't think this is going to work. But you know what? They got the numbers to back it up. So let's see. I have personally added to my trading strategies that I thought were insane and there no way would work. And then after watching them for 6 months or a year, I'm like, oh my gosh, this is great. And I got to add that to my repertoire. So look, you've got to be open to learning new things. And if you're cocky and you think you're hot shit, you pretty much close your brain off to that.
Yeah, well, now I'm wondering what Cedric thought of me when he talked to me, because I brought something pretty new to the table. Maybe that's why you guys brought me on. I was using indicators and a combination of indicators, which almost nobody was doing back then. And I had numbers to back it up. Maybe that's why I got on. Who knows? It's so funny you say that, thinking back. I get that comment on YouTube sometimes, and they always throw the experience out there. And I always think back, too, to jobs I've had and some of the worst people at those jobs. Just cancerous people, but you couldn't get rid of them because they knew every step of the handbook on how not to get fired. And anytime you would challenge them on anything, they would always lead with, I've been here 20 years. We'd be like, yeah, and you've been terrible for 19. It doesn't mean anything. So it is funny you say that, even though you and I are both experienced, and we do talk about our level of experience here on the show, just to qualify ourselves, I know exactly what you mean. I know the type. I've dealt with them too. So that's funny. You can be overly cocky early on, or you can be overly cocky 15, 20 years in. Doesn't matter. There's two different types. So anything you want to kind of end off on with this point? I think we've gone into it fairly well. Is there anything else to add on?
No, I really just hope that anyone who has listened to that last rant, and that's you, and you've thought, hey, I'm going to go check out Maverick Trading. Well, now you know. You can just skip on by.
Right on. Well, then I guess on that note, I've gone over mine. You've gone over yours. We talked in last episode, why these things are happening. I'm not sure what would lead to this level of cockiness for experienced traders. I can't figure that part out. The cockiness on newer traders, I totally get. You find something that works, you get these huge delusions of grandeur. I thought everybody on Wall Street was stupid and I was going to crush them in every possible metric. I've been there on that one. So I get that. The cocky trader later in life thing with the more experienced angle, can you maybe point to something psychologically where this might be happening in their world?
Absolutely. And, when you say experienced trader, everyone has different ideas of what that means. Some people say that's more than 5 years, 10 years, 15. Let me tell you what I've found. Most people, they've had a lot of success with a certain strategy. And in the mid-2000s, it was selling strangles in options. If you don't know what it is, it's basically you sell options and they expire worthless. And as long as the underlying doesn't move too much, you get to keep, free premium. And that was a big deal, and it really got fire, and everyone got really into it. And there was this woman called Karen the Super Trader. And Thinkorswim actually put her out front, like, hey, be like Karen the Super Trader, be like her. And everyone followed, and everyone was opening up websites to show you how to do this strategy. And you know what? It blew up. It blew up. That's what I've mostly found is that people have a strategy that they've used that's been really good. Right now, it's zero DTE options. If there is a bubble happening in the market, it is with zero DTE. They now have options that expire every day, and these traders will come and just sell those options and just collect the premium every day. And as long as the S&P doesn't fall 5%, it's like easy money. It's like easy money. Like 10, 15 cents a premium times 1,000 shares. It's easy. What's going to happen is that is going to happen one day. And it's going to completely devastate accounts because people are over leveraging themselves. So it's really more strategy based than anything. When someone has been doing this for 15 years, 20 years, they've had to do different strategies. If they haven't, then usually we find out they don't have the numbers to back it up. People that do have the numbers to back it up, they're always changing, they're always staying up to date on the market, and they usually are much less cocky.
Yeah, once people hear what I do, sometimes I'll hear these theories too. Oh, you trade too? And I'm like, oh boy, here we go. And sometimes they do have these can't fail strategies. And I'll always ask them, like, all right, so how could this possibly go horribly wrong? What would have to happen for it to fail? And a lot of times they don't have an answer. They're just like, really nothing because of X, Y, and Z. I'm like, oh, okay, all right, we're done. Because you know this. There's always something that could take something like that down, and there's always something that does, and when it does, they're not ready for it. They have no fail-safes in place, because why would you? It's the magic system. It's the system that never fails.
Patrick, don't you remember when oil went negative? No one had that on their bingo card.
I didn't even think that was possible. Maybe that's because I don't know how futures work, but I thought that was wild, and if I had half a mind, I would have bought. But it's like, okay, if it can go negative, it can go further negative, right? So, man, yeah, it's one of those things. Yeah, I know so many people, or anecdotally on Twitter, that got wrecked on that too. So, yeah, anything can happen. It always has. And these people go right back into the graveyard with everybody else. So I guess on that note, Rob, do you have anything more to add here, or should we close this one out and maybe have an earlier...
Nope, I feel much lighter. I feel like I've got a lot off of my chest. So I'm feeling better about this therapy session.
Are you feeling less surly?
I am. I'm feeling less surly. Thank you.
Well, we have done our job here, and thank you, everybody, for joining us here on the Trading Psychology Podcast. Rob and I, we'll see you next episode.
Goodbye, everybody.
This is the Trading Psychology Podcast. This is VP, creator of No Nonsense Forex, and author of the book No Nonsense Forex Trading Psychology, a great Christmas gift, by the way. And with me, as he is every week, it is everybody's favorite raconteur. It is Rob Reinhold.
Okay, you've really upped the game on these adjectives, and I don't even know what a raconteur is. Please explain that to me.
Okay, I really didn't either, so let's go to Gemini where I found it. A skilled storyteller.
Okay, all right, I'll go with that. It sounded like a derogatory term at first, but I'm okay with that.
Okay, now, wouldn't do that to you. If I did, it'd be very, very obvious. So we are moving into some, I don't know if it's more of an anecdotal episode or what it is. I hope this applies to a lot of you, because if it doesn't, then this might not be the most entertaining episode in the world, but maybe it would be. I don't know. It's worth putting together, I think, because I don't think your average low IQ kid really goes for something like trading. It's not a knock on them. I just don't think it's something they're really all that interested in. So I think Rob will be speaking to a lot of people today in an episode called The Smart Kid. Now, we probably need to define what this means. I'm just going to go with the definition that maybe not everybody's going to agree on, but I guess it's what we've all kind of come up with, and this is what most people agree on, and that would be IQ. There are many, many ways to be smart. There are many ways to be dumb. But if we have to default to anything, I would say probably IQ. Are you okay with that?
It's the best we have. I'm not okay with it, but it's literally the best we have.
Yeah, it's so hard to say. And as we're going to see in this episode, it doesn't always guarantee success. Often at times, it does. It's almost a death sentence in certain ways, because it's, well, we'll get into it. And we've talked before on this, and I don't like talking about it because it makes me think I'm separating myself from everybody else. But in school, I was known as the smart kid. I went to a Catholic school, and we had to get up and read parts of the Bible in the middle of church. Like, every kid would come up and do it. I was in kindergarten. Every kid would stumble with the reading. I did not. I read it perfectly. I would win all the flashcard math games in school. I would just run over everybody else, and that's just what it was. And so I was known as the smart kid. And so I had all these expectations put on me because that was my identity. I wasn't the most athletic kid, the best looking kid, the funny kid. That's what I had, and that's what I carried with me. And so it probably really screwed with me later on in life. But I'll kind of tell the story of how it affected me growing up and how it affected me in the trading world. And then also the one thing I really figured out that made this what I would call a handicap all completely go away.
Patrick, as I've gotten older in life, we grow up and we go to school, and you're like, oh, I got to take math, or I got to take science, and I got to take art, and there's all these subjects you didn't like. For me, my hardest subject was art. If a teacher gave me a piece of paper, said like, draw whatever you want, that's an F right away, because I wouldn't even get anything on the paper. Now I'm older, I'm looking back on why we set up the schooling system the way we did. And this really about this episode is that you don't know the possibilities and the strengths and weaknesses of any human being when they're 5 years old. So what do? Hey, let's expose them to as many things as possible over the first 18 years of their life. And they'll fall into what they're good at, and anything they're bad at, they just won't like. And I saw that with my kids. My daughter is terrible at math. She's never been good at math. She's never liked math. So I remember at a certain point, I just said, hey, look, your job is to get a D in math, and then you can never think about it again, because you are never going to have a job with math. And we realized that and recognized that after years and years of like struggling and tutors and tears at the kitchen table. And so I finally realized, oh, this isn't your strength. Let's just focus on your strengths. And so really, if you think about the way we put schooling together, is we have all these subjects. We require you to take an art. Why do we do that? You might be really great at it. You might have a talent at it. I didn't. I remember in college, I had to take an art class, and my roommate had to take a math class. we decided on the first day we were going to show up to each other's classes, and I somehow faked his ID to take his math tests for him so we would both pass the class. So I think in the end what happens is I think everyone will be able to relate to this episode, because the reason we chose to do trading in the first place is because we were one of those kids that was, hey, we showed some sort of talent at this, we showed some sort of smarts, and we are suited for this. So I think everyone listening to this is going to relate.
Well, two things. One, as soon as they asked you to draw anything you want, you should have just drawn dicks like they did in Superbad, and then they would never ask you again. Two, Father of the Year moment right there. I wish I had that kind of encouragement, because as soon as I got labeled the smart kid, I was expected to get straight A's and everything. And I did, up until the point where I didn't anymore. And we'll talk about that too.
Well, you talked about not wanting to be labeled a smart kid. My concern as a father was that my kid be labeled the dumb kid. And I remember they wanted to take her out of class and send her to resource. And I lost my mind. I said, absolutely not. She's going to get a D and an F within the same kids. They're not going to know what her score is. I don't want her dragged out of class to where then she starts to think like, oh, I'm not smart. She is brilliant. She's 26 now. This girl's amazing in so many ways. And I'm like, I do not want her labeled as a dumb kid, because those labels really cause issues. Both the smart kids and the dumb kids, they've got baggage now.
Yeah, and I want to talk about something that's going around on social media, and it's gone around on social media probably for the better part of 5 years now. And I'm sure it messes with people too. It's what I call the midwit curve. Rob, I think you've probably seen, I think everybody's seen this before. It's a bell curve, and on one side, on the left side, you have your dimwit. It's usually a picture of some guy with his, half of his head sawn off and he's eating crayons, and that's your dumb guy. And then on the right side, you have your super enlightened, intelligent guy. And then the middle, that's the top of the bell curve, so that's where most people are the constantly frustrated, quivering, shaking person who's just sitting there overthinking everything and thinking of all these reasons not to do something or to criticize something, to where the guy on the left and the guy on the right are both thinking the exact same thing. And I guess the theme of the lesson learned in that midwit curve is to not overthink things. I think it's funny, right? And it's poignant in a lot of ways. It's like the guy on the left and the right, they just buy Bitcoin, to where the people in the middle are talking themselves out of it left and right as price just keeps going higher and higher. I get the idea behind it. But I want to present a different angle to that. Do you know the meme I'm talking about?
I don't, but I'm sitting here smiling, and I just realized I'd never had that thought before, that the person on the far right and the far left of the bell curve are both convinced that they can do it for two totally different reasons. Oh my gosh, it's so funny.
Yeah, but it's completely wrong. The overthinkers are the top wits. Ask me how I know. And I've known other people like this too. It's good until it's not. And man, I tell you, the expectations you have in life as somebody who has a high IQ, like if I took an IQ test right now, I have no idea what it would be, but I do know what it was back then. It was high. I took it twice. I don't even want to say it out loud, but this is something I carried with me for a long time. And I read a book on this a while back too. And it hit me in the feels in so many different ways, because it talked about my own upbringing. It said, look, the world is not set up for people like you. The world is set up for the people in the middle, because that's where most of them are. You have to understand that. You can't take it personally. You can't sit there and build the world for the people at the very top. There's a very small amount of you that's not fair or right to anybody else, and everything's going to fall apart if you do it that way. So the world has to be set up for the middle. So you are constantly going to be frustrated with everything. And God damn it, Rob, if that wasn't so true, I was frustrated with everything in school. I was frustrated with the way my peers saw things. I was always the oddball. I always saw things a certain way. As I got older, the things I liked in pop culture, in music, were just completely different than everything else. Yeah, you know how it is growing up. You always think like the stuff you like is great and all the other stuff is just trash and the people who listen to it are idiots and all that kind of stuff. But multiply that by, a factor of 4 or 5 when you're talking about, the smart kid and stuff like that. The world is always against us in some way. And I think over time it causes us to overthink, because we're always suspicious about the way things are. And so I think our brain just goes into hyperdrive sometimes. Have you known people like this? And can you relate to this at all?
I think the best story about this comes from Malcolm Gladwell's book, The Outliers. In chapter 2, he talks about intelligence. And this is the first time I'd ever heard this story about a gentleman named Christopher Langan, Langan. He is regarded to be the smartest person in the world, the person with the highest IQ. But his story is kind of one of tragedy, where he went to high school and he was bored. And so he asked his teachers for more work, for harder work. And they all didn't like him because he was a jerk about it. And so he just sat there and read books on his own. And when he took the SAT, he got a perfect score while taking a nap during it. So he napped during the SAT, he got a perfect score. He was able to get into a really good college, but then he got kicked out of college because he was always fighting the system. He always thought he was the smartest person in the room, which made him unlikable. And actually his life, people are, looking at him saying, hey, this guy should have been everything. This guy should have been the most successful. But yet he had that attitude of being the smart kid to where he never learned how to fit into society. So I think this is the all-time best story. And if any of you want to pick it up, it's in chapter 2 of Malcolm Gladwell's book, The Outlier. It really goes to show that intelligence isn't the key to success.
And I know who you're talking about. Yeah, I think he has a 200 IQ. He's kind of a middle-aged man now, and he worked most of his life as a bouncer, which is really not a good idea. It's not a good profession to have, provided you could do something else. But that's what he did for a very long time. Now he lives on a farm in the middle of nowhere. He's married. Seems quite happy. But yeah, he did have a rough road, because the world is just not built for people like that. So you constantly feel like you're against it. And at the end of the day, here's the worst part about it. Like the reason why, especially when we're younger, we try to wear it like a badge and really try to rub it in people's faces is because that's all we have. And it's at the end of the day, you don't win anything for being high IQ. You get nothing. You definitely don't get girls. That whole thing is some horse shit that I learned the hard way. You watch these movies and TV shows growing up where the smart guy gets the girl. Never, ever plays out that way. That's not really what they're attracted to, over and above anything else. And you kind of learn that it's the midwits that really figure it out. The people on the smarter end of that midwit curve are really the ones that just kill it, because they know what they have to do and they have an easy time doing it. They're like, look, maybe I'm smarter than this, but this is what I'm being asked to do. And then they just do it and they crush it. And that's, if I had to do it all over again, that's probably where I would rather be. I think my upbringing would be a lot easier. My upbringing, as far as my parents go and stuff like that, was great, but the pressure I put on myself and this world that I created around me that just didn't fit in with anything else was really, really difficult. Now, I know people are going to be like, oh, I'm not going to cry for the smart kid. I don't expect you to. I just want people to understand that it's really not all cake and ice cream for us. It's really the opposite, because we don't feel like we fit in ever. And sometimes you can really go off the deep end with this. I know people who have, and it's really a shame, because they had such a rare gift and it didn't have to be this way.
That was basically Malcolm Gladwell's conclusion in The Outliers, was that you don't want to be highly intelligent. You want to be somewhere, as you said, not in the middle, but a little bit to the right, to where, okay, you're a little bit smarter than the average person, but you're not so smart that you think you know the best way, that you learn how to work within systems, you learn how to be humble. And really, that's the big story of Christopher Langan, was that he wasn't humble in his life because he knew he was smart. He was by far the smartest person in the room, and yet he was never able to capitalize on it because he wasn't humble. And I think that's really what this comes down to. And I want to just use the stock markets, the Forex markets, all the markets. There are people out there that think they're smarter than the Forex markets. No, you're not. You're absolutely not. And having that attitude, look, I had that attitude. Hey, I was a smart kid. I'm smarter than a lot of other people I know. I can figure this out. And I looked at the market. I'm like, this market's wrong. This dumbass market is wrong. So I'm going to take a counter trend trade because it's stupid and I'm smart. Boy, I had lessons to learn my first couple of years about counter trend trading because that was directly tied to I'm smarter than the current price action.
And I felt the same way when I discovered indicators. I saw most people trading price action. I saw indicators were a thing. I started using them. I started finding some more obscure ones. I'm like, look who discovered gold. This is all I have to use, and I will get a leg up on all these dumb Wall Street traders, that went to school for 4 years because, I went to school for 2 and I flunked out. So I had an axe to grind because I still felt like I was smart enough to do this. And then you find this special little tool and you're like, oh man, now I'm off to the races. Not understanding that trading was more than using an indicator to enter positions. There's a lot more to it.
The old holy grail of trading that we've all found multiple times and yet has never had long-term success.
I found it so many times. And so, I think my learning curve was really stunted compared to somebody that can just take something and follow a very simple plan. And that's kind of how I want to get into the solutions part of this episode, Rob. We've gotten there kind of quickly. Do you want to add anything else to what we've been talking about so far before we get there? Because I do feel like this is a pretty good transition because we've been hinting at it this entire episode.
Well, let me just do a summary. If you're listening to this, you likely identify as the smart kid. And the reason you identify that because you were put through competition in your early years and you actually found out, hey, I actually got a little something more than the average. Again, that's great. We love self-confidence. We love all that stuff. But when you take that into the market, it gives you some issues. And if you lack humility, the market will teach you humility. It will absolutely teach you. And I know a lot of you are nodding your head right now. I personally had to be humbled before I could actually learn how to become a good trader. I had to become humbled. I hate to admit that. I absolutely hate to look back and be like, oh, that big loss I took in 1999 that pretty much wiped me out. I had to take that in order to really be humble enough to learn how to trade correctly. It sucks. And if you can just get over that hump, if you're new at this, take all of these old people, take all of our word for it. Don't go into the market humble. If you don't, trust me, the market will humble you. It's much easier just to go in there humble.
Yeah, I mean, there's been so many really smart traders that have come through the ranks in the last 30, 40 years. For you to be like the top 1, 2, or 3 is almost impossible. So no matter how smart you were leading up until now, don't assume that you are. Just don't make the mistake we all made. The market will humble you at some point. The worst thing it can probably do is not humble you early on and you just start stacking and stacking and stacking pips. Because, I've talked about this on my channel. That's the worst thing that can ever happen to you because now nobody can tell you no. And even if you fail, you probably just think it's a matter of trying the same thing over and over again because you already saw how successful it was. So that means you're just going to keep failing over and over again without learning anything. Again, ask me how I know. One real quick thing, Rob, on a concept called lateral thinking. There's 2 types. There's lateral and linear. Lateral, think like big picture type stuff, like big idea type people like Elon Musk. Elon Musk probably, if you gave him a certain task, he might struggle with it. But, and I know Elon didn't come up with all these things that he does, but without him, they wouldn't exist. You need that big picture thinker that can actually come up with these things because your average person cannot. 99% of the world could never come up with any of these things, much less execute on it. So I feel that certain smart kids have the ability to do this, but the problem is when you're going lateral, when you're going side to side, you're not going down the line. And that's called linear thinking. And this is what most people do. Most people, if you give them a step-by-step plan, whether it's putting together Legos or putting together a trade plan, it's a step-by-step process. It's very black and white. And linear thinkers are good at following these things. Lateral people are not, because their brains go in every other fucking direction except for straight where they need to go. And so this is a constant problem too. I don't know if this is unique to high IQ people or not, but I bet you there is some correlation there.
And Patrick, this is literally the second letter in your Myers-Briggs personality test. I can't remember which episode it was, but we have a trading personality test at Maverick Trading. We have all of our traders take it, and it's based on the Myers-Briggs, but based on trading questions, like how would you handle this trade? And your second letter is either going to be an S or an N. S is sensors, N's are intuitive. And this is exactly what you just said, lateral thinking or linear thinking. N's are lateral thinkers. And the further you are on the end, on an N, the more big picture you're going to see, but the harder it's going to be for you to get into the details. Oh, details don't matter. I don't care about the details. And the further you are on the S spectrum, the more you're going to be a linear thinker and really struggle on the lateral thinking part. Like almost everything in this world, it's best to be in the middle. Just like we're talking about with this bell curve of intelligence. When you have very strong tendencies on one end or the other, yes, they're wonderful in a lot of situations, but they could also be your curse as well. So if you are interested in figuring out if you are a lateral thinker or a linear thinker, either take the Maverick Trading personality test or just go take a Myers-Briggs personality test. Your second letter will tell you.
Yeah, I don't know, man. I don't know if there's really a place for lateral thinking in trading at all, unless you're trying to create something from scratch. I mean, I would say I'm solidly in the lateral thinking category. I did come up with something the trading world had never seen before. That does count for something, but my problem was always following it. I had the hardest time following my own system half the time. As a strategist, I felt like I really had something special, but as a tactician, somebody that needs to actually go in there and do the thing, that's what I really struggled with. So I feel like that's a really good segue moving on to the solutions portion of this episode, Rob. And we have a good list of things here. First of all, know where you fit on the curve. All right, don't think you're on one side or the other side because it sounds good. Know where you actually are. And I think that personality test that Rob talked about, which was in episode 2, by the way, and it's linked down below in the show notes, so you can go take it right now if you wanted to. I think knowing where you are in real life as opposed to where you think you might be is a really good first step. Rob, what do you think?
Patrick, that is literally the first step at Maverick Trading. The first thing you do after you go through our orientation is you take your trading personality test. We talk about what you're going to be good at, what you're going to be bad at, and we stress that while you're building your trading system, don't try to do the things you're bad at. And that's just what you were talking about, is that you were great at developing this new strategy, but you had a hard time implementing it. Well, you finally figured that out by automating it and doing algorithms. I mean, that's exactly what we're trying to lead people to do at Maverick. So if you just jump into trading without understanding who you are, you're going to fail at a lot of things that you just aren't good at. Understanding who you are, where you are, your strengths and weakness, I think is the step one of trading. But sadly, most of us just jumped in and started clicking buttons first, and then we had to learn that later. That's what I had to do.
And so continuing from there, if you are on the higher end of that bell curve, understand a couple things going in. Number one, the world owes you nothing. Hopefully, at this stage of your life, you should have figured that out. But some smart kids never get there, and it affects everything they do. So if you can get that out of your head right away, the world doesn't owe you anything more than somebody on the complete opposite side of that bell curve. So get that out of your head. And then also figure out the things that you're just not good at. We think we're good at everything when it comes from an intellectual pursuit, but that's not the case. We always lack something, and smart kids lack a lot, like we just talked about, being able to stay on that line and follow things step by step, which trading requires. Might be something you're really not good at. You have to have enough humility at this point to at least know that. You can think you're badass at everything else, but figure out the things you're really not good at, and we'll talk about what to do with that in a moment, but at least identify it, because it's just like we do on the show here, Rob. We at the very top of the show, we identify the problem, because if you can't identify it at first, then it doesn't really matter what we talk about if you're not aware that you have these issues in the first place.
So true. I turned 50 this year. I never thought I would be 50. I mean, I'm still, in my mind, I'm 21 years old. And I hit 50. And one of the things I have loved the most about getting older is that you stop lying to yourself about what you're good and bad at. I was convinced, just like, oh, we need to hire someone to fix the drain. I'd be like, why would we hire someone to fix the drain? I know how to fix the drain. You think I did a good job at it? No, I hate fixing drains. It's terrible work. So I used to tell myself, oh, you can do it better. You can do it better. You can do better. And I ended up doing crappy jobs in things that I could have just had a really good person do. It would have saved me a lot of time and ultimately money, because I thought I was saving money, but ultimately it had to be replaced because I did such a bad job. It is so great as you get older. And again, I'm going to give this to any younger people that are looking at getting older, say, oh, it's going to suck. Look, there's stuff that sucks. But one of the great things is you really come to accept yourself, and you stop lying to yourself. Like, my wife won't let me paint anymore. About 10 years ago, she's like, you're terrible at painting. I'm like, thank you. I know I'm terrible at it, so I just don't paint anymore. It's one of these wonderful things. So the earlier you can get there in your trading to where you say, hey, I'm really good at creating these systems, but I'm really bad at implementing them. Hey, now you've identified the problem. Now it's just about a solution.
And that's a great thing to point out, too, because the majority of our audience, I would bet, is under the age of 50. So if that really is the cutoff point to where most people figure it out in terms of understanding what they're terrible at, then the rest of you really need to take notice on this part. By the way, take a drink every time Rob says he's 50. Moving on to the next one. Knowing when it's time to think linearly, I have this written down, it's really all the time. Trading doesn't care how good of a lateral thinker you are. If you can't follow something and follow it correctly all the time, nothing else matters. It's not like you enter your IQ into your brokerage platform and then they give you benefits for that. It just doesn't care. It will spit you out so fast. Understanding when it's time to follow something, and really that time is all the time, is key. Nothing else matters. Now, this is one of the solutions for the next episode, but I'll give a little bit of it away now. You might, under worst case scenarios, if you just can't get this figured out, you might want to go ahead and automate. We talked about this, I think, back in episode 50, Rob. It is a solution, and I don't really think it's a compromise. It might just be people coming to this realization that, yeah, there's certain things in this world we suck at, but we still want to do well at trading, and this is one of those ways we can do it.
For probably about the last 20 years, I've been saying that the greatest thing about trading is that it is the ultimate equal opportunity employer out there in the entire world, meaning it doesn't even know if you are male or female. It doesn't even know if you are old or young. It doesn't know if you're black, white, Asian. It doesn't even know. This profession is the ultimate meritocracy as far as equal opportunity. And I love that. I love that. Equal opportunity. It's all about, do you know what you're doing? Do you have a good system? Can you follow that system? It doesn't even know who is clicking the button. All it knows is, did the button get clicked at the right time? And again, if you need to automate that, automate it. But I love that about the market. It is the ultimate meritocracy in this world.
I do too, as part of the first chapter in my book. And I can remember, he's not around now, but I had a constant YouTube commenter. And you could tell by his picture, I think he was in a wheelchair. I think he had cerebral palsy or something like that. And he was like really small. And he said after a while, he's like, look, man, I have this condition. I have all these things going against me. Do I have to do it this way, or can I do that, or can I cut corners and just do it this way instead? I'm like, I had to give some tough love to this guy. I'm like, nope, you don't get a pass. You have to do it just like everybody else does. And you said it right. That's the greatest part of this market. It just doesn't care who you are. It rewards people who can follow a system consistently without deviating from it. The end. And so that's my other solution is I think one of the biggest problems smart kids have is they take forever to put a system together. Because in our world, we're such lateral thinkers sometimes, there's always all these different possibilities. That's why I was good at math, because it said, okay, just do this. Okay, I can just do that. Algebra now has all these other possibilities, so I would always overthink it. I'm like, oh, well, what if it's this? What if it's that? It's probably this, but what if it's kind of a trick question? I could never wrap my head around it. I took it 4 times, never passed. I think school just gave up. But that was how I was building my system too. I'm like, why would I put this indicator here? Well, there's possibly another one better out there. I should just go look for that. And then my system never got built. I finally just said, screw it, put something decent together, and I started trading that. If Rob's Flat Earth Trading Society video taught us nothing, it's that it almost doesn't matter what your system is. If you get the money management and trading psychology part right, it's going to be fine. So I literally just put anything out there and start trading with it. As Rob's video shows, it's probably going to make you money no matter what. And then over time, on the side, away from actual trading, you can be this mad scientist lunatic and start playing with all these different combinations. But I think where so many people got it wrong with my system, Rob, is they just went too far with it and they never put something together. And they were just in this constant state of building, and ergo became in this constant state of frustration and probably just quit over time because they just got overwhelmed.
Patrick, you did a great job of illustrating the difficult of the lateral thinkers. I have met many linear thinkers who are constantly building a system, and it's never good enough. It's never good enough. And I've known some of these people will be building systems for 5 years and they've never put real money behind it because they're still testing it. Because in their mind, this is the engineer brain. Every time you flip a light switch, the light comes on. And if it doesn't come on, it means there's something wrong with it. And they take that mindset into trading where, hey, there's something wrong here. I need to keep working on it so I can get rid of all the mistakes. Well, this is not a game about perfection. This is a game about making a little bit more money when you're right than you lose when you're wrong. That's the game. It's all statistics. And they just don't understand that in their brain because every time you flip a switch, the light should go on. That is not how trading works. So people who are very strong linear thinkers, they're also going to get stuck to where they're going to get, quote, overwhelmed, and it's overwhelmed because they don't think it's perfect enough. So there's 2 problems here. Lateral thinkers all over the place, doing all this stuff, never can get it implemented. And then you have the engineer types that are never happy that it's perfect enough.
Yeah, and that's where I think that my system of trading, and I will give it credit, really caters well to both. It caters well to linear thinkers because instead of price action, where you have all these different price action tools on the chart, and you don't quite know which one you should follow or which time frame you should be on or this or that, it gives you definitive signals, so you always know what to do. And I think it also works well for lateral thinkers because it centers them onto something. This is a very A equals B equals C system. And if lateral thinkers can just get out of their fucking heads about it, this is something that could really benefit them, because it also teaches you that, hey, if I just stay between the lines for once in my life, really good things can happen. So maybe I should just do that. I don't know how old you got to be to figure this out, but let's just say the younger the better. And I'm glad I finally did. The whole reason why I'm just not spiraling out of control in a drunken rage right now at this stage of my life is because I was finally able to harness all that crazy brain energy in and just say, okay, there's a time and a place. There's a time to be a lunatic and have all these ideas in your head, and there's a time to just color within the lines and just let it happen. And so that's what I did. And the final thing, Rob, that I have written down, that I always try to remember even nowadays when I do other business things and other trading type things, is the whole saying. There's a saying called "perfect is the enemy of good." I don't like that, because I think people will see the word perfect and good and like, well, I don't just want to be good. Why settle for good? No. To me, perfect is the enemy of progress. You're never going to get anywhere. And I know there's so many people building no-nonsense Forex trading systems right now that need to hear this. Stop trying to optimize everything. Just get out there, like we said before. Pick any combination of fucking indicators and put it together with decent settings and just start trading it. Just go. Get those reps in. Get that experience. Learn the money management and trading psychology side in real time with a half-assed system instead of trying to over-optimize, because perfect is and will always be the enemy of progress.
So true. And Patrick, I don't know if I've mentioned that I'm 50 years old, and it took me being a 50-year-old person to really understand that point. Now, look, I'm just trying to get some people drunk here, because you said that every time I mention I'm 50, people have to drink. So
I'm in the can right now. We got one episode to do after this.
All right. Well, then I will no longer mention that I am 50 years old, Patrick. Ooh, sorry. That's one more drink you got to take. But no, you summed it up perfectly. Look, the only way to get better in life is to fall down. One of my favorite sayings is the only difference between successful people and unsuccessful people is that when they fall down, they fall forward. So when they get up, they actually moved a little bit. And then they fall again, and they got up. That's the process. Trial and error. That's how we all learn as humans. There's no way to get better without error. So go out, try it out, fail at it, figure out what failed at it. That's the process of becoming great at something. Now, I learned that as a 50-year-old man.
Well, I'm glad you finally got there, Rob. And on behalf of the 50-year-old Rob Reinhold and myself, thank you, smart, dumb, and medium kids, all for joining us here on the Trading Psychology Podcast. Rob and I will both see you next week.
Goodbye, everybody.
This is the Trading Psychology Podcast. This is VP, creator of No Nonsense Forex and author of the book No Nonsense Forex Trading Psychology. And with me, as he is every week, it is the always sanguine Rob Reinhold.
Again, you keep using these words. I've heard this word before, and I should know what it is. I know I've actually looked this word up. My brain can't get it. What is sanguine?
As you were doing that, I just typed in the definition. It means optimistic or positive, especially in an apparently bad or difficult situation.
All right. I will take that. But you've never seen me in a bad or difficult situation. I fall apart. I'm a mess.
Yeah, it's a bit of a good lead-in, actually, to this episode. And if you remember our Smart Kid episode from a very, very short while back, this is almost an addendum to that. I've been asked in the past, because I've mentioned on my YouTube videos my ADD, my attention deficit disorder, and a lot of people, it turns out, in this game, Rob, also at least believe they, I don't know if they suffer from this is the right word, but we'll use that for now, and have wanted me to do either a blog or a whole dedicated video on this. And I just didn't feel like it really fit with what I was trying to do, but I think it fits here. And I know, just like the Smart Kid episode, this may not apply to everybody. I mean, we all like to think we're smart, but I don't think all of us think we have attention deficit disorder. So let's go ahead, before we get started, and define the terms. So the first thing to mention is a lot of people confuse ADD with ADHD. ADD is attention deficit disorder. ADHD is attention deficit hyperactive disorder. There's a very big distinction. If you want a good comparison, I have ADD. If Rob did have this, he would probably have had ADHD growing up the way he describes himself. Rob, do you think that's fair, or have you been diagnosed with this? We never talked about it.
My daughter is convinced that I have ADHD, and she's like, Dad, you got to go online and take a test. And I'm like, yeah, I should take a test. And then I realized, I don't want to know. Like, I'm pretty happy with where I am. So, if I had it, great. If I didn't, great. It's who I am. So again, I don't see any need for me to label it at this point in my life.
Yeah, and people have to be really careful with it too, because I remember when I first had it, it wasn't a big thing. And then it became a bigger thing because pharmaceutical companies want to get kids hooked on Ritalin and Adderall. So it became a much bigger deal, and then it was often misdiagnosed for this reason, because we know the game that Big Pharma likes to play. So that was that. So that just made it worse, because then people thought I was just making it up as an excuse for not doing well in school or for always forgetting things, whatever the case was. So that was really frustrating. Adding to my frustration later in life was something you talked about when we put this episode together, Rob. I've also been told that I am somewhat on the spectrum. Now, when somebody says that, they're talking about the autism spectrum. And I'm like, no, that's something that just got made up in the last 10 years. I was never on it before. I don't really display a lot of those tendencies. I know kids that are full-blown and how they act in everyday life, and I am not like that at all. But Rob, you had a really interesting counterpoint to that. Do you remember what it was?
Absolutely. And this is it. We are all on the spectrum. Now look, the definition of a spectrum is that it goes from one end of the extreme to the other end of the extreme. So when we talk about the autism spectrum or any spectrum, you are on it somewhere. Wherever you fit on that spectrum, you're going to have those certain traits. And sometimes those traits are going to be really positive. Sometimes they might be negative. But we're all on the spectrum somewhere. We all have our little quirks. We all have our little weird things. For me, I'm not saying this is part of the autism spectrum, but for me, I have a terrible memory. I forget everything. I can remember every number I've ever seen in my life. That's not true. Not every number I've seen, but I'm really good with remembering numbers. But everything else, it's like I have kryptonite around me when it comes to remembering things. It is such a weakness. And that's the point I wanted to make about this episode, is that